Welcome and good morning. I'll call to order this third meeting of the joint CFTC-SEC Advisory Committee on Emerging Regulatory Issues. The date's August 11th, 2010. This meeting is held in accordance with the Government and Sunshine Act, and we're joined by all of the members of the Advisory Committee, I think except for Brooksley Bourne and Susan Phillips. And I believe Susan Phillips may be joining by phone, maybe Brooksley. As we have done in our prior meetings of the committee, my co-chair, Chair Shapiro, and I will share the presiding officer's duty, but first I'd like to offer Chairman Shapiro the opportunity to make some opening remarks.
Thank you very much, Gary. I also want to join Chairman Gensler in welcoming all of our committee members, and again, thank you for the time and the effort that you've invested over the past few months as we continue our review of the May 6th events. As part of the SEC and CFTC review of market events on May 6th, we're pursuing really two related courses of inquiry. The first is empirical and data-driven. SEC staff have been reviewing raw transaction and order data, order book snapshots, trade summaries, information about broken trades, and information related to the initiation of LRPs and self-help. The second area of inquiry is focused on extensive interviews with market participants, their firsthand accounts of what happened on May 6th and their responses to those events throughout the course of the day. These efforts will culminate in an SEC-CFTC joint report that will be presented to this committee for its consideration next month, and of course we will share it with the public as well. As part of our review, we've sought input from institutions and individuals who can help us build an understanding of what happened, how it affected market participants, and how we might best avoid future events of this type. At our last Joint Advisory Committee meeting, representatives of the various exchanges discussed their experiences and their observations of the markets on that day. Significant market participants also shared their views and observations regarding liquidity, trading, and the apparent breakdown of an orderly market. Today, the committee will hear panelists describe the impact of May 6th from the perspective of investors, both large and small. And we think the investor perspective is crucial to understanding these events and to fostering stronger capital markets. As you know, following May 6th, the SEC has undertaken two immediate policy responses. The first was to work with the exchanges and FINRA to develop new stock-by-stock circuit breaker rules. These rules, which were approved by the SEC on June 10th, require the exchanges and FINRA to pause trading in S&P 500 stocks when they experience a 10% change in price over a 5-minute period. This pause, which is currently applied on a pilot basis, gives the markets the opportunity to attract new trading interest in an affected stock, establish a reasonable market price, and resume trading in a fair and orderly fashion. In June, we published for comment proposals by the exchanges and FINRA to expand this program to include all the stocks in the Russell 1000 index, as well as 344 specified exchange-traded funds. And we're currently reviewing the comments received on those proposals, and I hope we'll have Commission approval of this phase of circuit breakers very soon. The second policy response was to work with the exchanges and FINRA on amending their rules for breaking clearly erroneous trades. As the committee heard previously, after May 6th, the exchanges exercised their existing authority to break clearly erroneous trades that were affected that day at prices 60% or more away from the pre-decline prices. The process that was used to draw that line, however, was neither clear nor transparent to market participants, and we've received reports that the lack of clear guidelines for dealing with clearly erroneous transactions and the lack of transparency surrounding the decision to break certain trades but not others created uncertainty for investors and others about how such transactions would be handled in the future. The proposed rule changes are designed to address these concerns by setting clearer standards for breaking trades and curtailing the discretion of the exchanges and FINRA. These proposed rules were published for comment in June, and we're now reviewing the comments received. We're considering as well whether other steps are appropriate to reduce the risk of sudden disruptions and clearly erroneous trades, including deterring or prohibiting the use of stub quotes by market makers, and we're studying the impact of trading protocols at individual exchanges, including the use of trading pauses, price collars, and self-help rules. And finally, we're looking closely at other mechanisms that may contribute to a more stable market, such as instituting limit-up, limit-down mechanisms. As we continue to examine these and other issues and to consider actions that may further protect investors and stabilize financial markets, it is critical for us to continue to hear a variety of informed views. Today's guests and, of course, our committee members will, I'm sure, not only shed more light on May 6th, but provide some of those knowledgeable perspectives that we need. I want to thank you again, all of our guests who are speaking, as well as our committee members for being here today. Thank you, Gary.
Thank you, Mary. And today we'll continue our examination of the market events that took place on May 6th. I want to thank you for co-chairing this meeting, and I look forward to our continuing work together on these issues, but also with regard to the Dodd-Frank bill. I mean, this right here, my friend, our two sets of commissioners, who I'll introduce in a moment, our commissioners, we're going to be working together very closely. The Dodd-Frank Act, for the first time, brings the over-the-counter market under comprehensive regulation. I know when you chaired the CFTC, you sort of you nosed up to that. You tried, but now Congress has actually given the SEC and the CFTC the necessary authority. So I really do look forward, and I can report to the public, our meetings to date in the last month have been remarkable. We set up 30 teams. The SEC set up a different set of teams. You all have more work than we do because you have credit rating agencies and a lot of other investor protection issues. But some of these teams have met 5 and 6 times already. They exchange emails, and it's really been a cooperative. We won't always agree, but I think that we're going to agree on most. And where we disagree, hopefully we'll disagree agreeably. So I wanted to thank you for that off script. But the agencies, of course, are also working together on this issue around May 6th. And this advisory committee of emerging issues and the expert panelists we're going to hear from today are critical with regard to this review. I want to thank the CFTC and SEC staff for all of their hard work in planning this meeting and, of course, everything they're doing around May 6th. I want to thank my fellow commissioners, Mike Dunn, Jill Summers, Bart Chilton, who were able to attend today. I know that Scott was unable to attend, but I want to thank all of you as well. The market events of May 6th require continued review. The staffs of the joint agencies put out a report, I guess it was May 18th, which was only 12 days after, which I guess with the rule writing we'll have to do some deadlines similar. But today's meeting will be part of that ongoing process, building upon those staff reports. I think we're shooting, as Chair Shapiro said, for September, maybe even early September, that the staff will deliver the follow-up report concerning May 6th. Based on the research the last 3 months. But then we really look forward to this committee, this expert committee, to come back, and we're hopefully going to set short deadlines for that too, with your recommendations, whether you're able to do that as soon as the following month, but we're hopeful to really get your thoughts on this as well. So I look forward to the informative dialogue today with the panelists and with the committee members. And I want to thank again the CFTC and SEC staff. With that, I think I'm supposed to just introduce some of our panelists, and then we get going. But we're pleased to be joined by the panel of witnesses today. This panel will focus on the investor perspectives of those events. We're joined by representatives of exchange trading funds on ETFs, a pension fund, individual investors, retail investors, and representatives of asset management and mutual funds. And we look forward to hearing from their experiences and comments on May 6th. I was wondering, aren't I supposed to introduce this group here too, our group? All right. So, but we're honored to be joined in person by 6 of our committee: Richard Ketchum, who runs FINRA; David Reuter, who once had Mary's role at the SEC; Maureen O'Hara, and Joe Stiglitz, and Bob Engel, who are 3 enormously distinguished economists and professors in finance. I'm blurring finance and economics. I'm just a washed-up finance guy, Mr. Brennan, who used to run I think the largest mutual fund complex, but maybe your second some days. Depends how you count. So we're deeply honored by the 6 of you joining us. And I said, I think that we might have Susan Phillips, a former chair of this agency and obviously a Board of Governors director, on the phone. Our witnesses today, Mike Mendelson, principal of AQR Capital Management. There, this side. I'm going left to right then, probably. Noel Archard, head of U.S. products for BlackRock. BlackRock probably might be now the largest asset manager. So it might depends how you count. Yeah. All right. So we'll count differently. Charles Rotenblatt, Vice President and Editor of American Association of Individual Investors. Chris Nagy, Managing Director, Order Routing, Sales, and Strategy for TD Ameritrade, probably first in something, how you count. Kevin Cronin, isn't that true? Retail Trades, I was sure. Kevin Cronin, Director of Global Equity Trading at Invesco. And then Pamela Craig, all right, Chief Financial Officer, Accenture. We'll now hear from our panelists, opening remarks, and begin from, I guess, the left. So I'm going to start over here.
Chairman Shapiro, Chairman Gensler, and members of the Joint Committee, my name is Michael Mendelson. I'm a principal at AQR Capital Management, an investment management firm that for the past 12 years has managed assets for pension funds, endowments, and foundations, and now also manages public mutual funds. Thank you for inviting me today to discuss our experience of the events of May 6th. The flash crash highlights a risk in an otherwise well-functioning U.S. market. While AQR and the great majority of other investors managed to avoid damage from this event, unfortunately not everyone did. We can reduce the likelihood of a repeat flash crash, and the work of this committee and the extensive efforts of the staffs of the SEC and CFTC may be the most important steps in that effort. AQR employs quantitative methods in most of its investment strategies. We invest in a wide variety of instruments, including U.S. equities. Our holding periods are typically months to years. Some of our investment strategies turn over every few days, but none would be considered high frequency. We are liquidity seekers, though we don't use market orders, and rely on liquidity providers to perform their essential function. In many of the markets in which we trade, such as fixed income, liquidity is provided by dealer firms whose ability to provide liquidity rises and falls with the health of the financial system. But in the U.S. equities market, liquidity is provided by a broad base of participants. This was a great benefit to all investors during the most difficult weeks of the financial crisis. Our exchange-traded markets performed admirably, and those responsible for that, from the small electronic market makers to the regulators who led us to a competitive, broadly democratized market structure, should be proud of this achievement. At AQR, we build safeguards into our trading processes and have human oversight of them, important steps for protecting client assets. On May 6th, our trading staff noticed early on that the market was potentially disrupted and shut down our equity trading. We suffered no busted trades, we avoided trading at dislocated prices, and we were able to complete the overwhelming share of portfolio transactions planned for that day. Nevertheless, May 6 revealed risks in the trading ecosystem that need to be managed. I'd like to highlight 3 issues. First, questions remain about the cause of the flash crash, but we know there was significant negative macroeconomic news, very heavy trading volume, substantial liquidity demand from market sellers, trade reports that appeared to be erroneous, and a delinking of our trading centers, with liquidity providers experiencing large profit and loss moves while fearing they were flying blind without reliable market data. It is easy to understand why they would have felt compelled to withdraw their limit orders. Meanwhile, liquidity demanders continued to send market orders, unaware that the typically deep limit order book wasn't. I want to emphasize the importance of unaware. Second, had some of the weak links been stronger, what alternative course could events have taken that day? Perhaps the evaporation of the limit order book was actually our good fortune, as the subsequent shocking trade reports screamed out to market sellers to stop. Without that loud blast, selling may have continued unabated, causing a real crash from which it would have taken far longer than 15 minutes to recover. The clearing of the limit order book may have acted much like a circuit breaker, albeit a very sloppy one. Better market data, better exchange coordination, and additional rules might have prevented the flash crash, but might have enabled a real one. I don't know. Careful analysis of market data may yield an answer, and I encourage the committee to work with industry participants to explore this. We need to understand what role demanders of liquidity had on May 6, and perhaps consider steps to better inform those participants of the live aggregate supply of liquidity. Third, the complexities of our trading environment should give us pause and at least drive us towards seeking lightweight and simple solutions. Toward that end, the current circuit breaker pilot program may be a good start, but modifications may be needed. We have seen as recently as last Thursday that erroneous trade reports can halt a stock. With broad access to the trade reporting facility, there is too much potential for substantial abuse, so perhaps consideration should be given to a limit offer rule. Another proposed solution is to impose market-making obligations. This will increase costs for investors every second of every normal trading day by reducing the availability of liquidity-providing capital and increasing its risk. Adding insult to injury, on those rare occasions when markets are severely disrupted, market-making obligations will accomplish nothing. After all, the function of a market maker is not to buy stock at the wrong price as a market is crashing. Market maker obligations come with special privileges, and some markets may need this to encourage liquidity providers in the ordinary course of business. But instead, here the suggestion is that privileges will encourage liquidity provision in extraordinary times. They won't. Thank you.
Thank you. So we're just going to go down the final. Noel.
Okay. Thanks very much. Good morning. My name is Noel Archard. I'm a managing director at BlackRock, and I head the product team for the U.S. Exchange Traded Fund business. I greatly appreciate the opportunity to speak with you today about the impact of the May 6 flash crash on investors and what steps we can take to prevent such market disruptions in the future. As the members of this committee know well, ETFs have become widely accepted investment vehicles for both institutional and retail investors. There are currently 985 exchange-traded products available in the U.S. market, with over $790 billion in assets invested. They represent 30% of the total volume traded on national exchanges, and they've become indispensable tools for a range of investment strategies. Institutional investors use them for a number of sophisticated strategies, such as cash equitization or as a low-cost hedging tool. For their part, retail investors also use them in a wide variety of ways, to build an asset allocation, as part of a core satellite approach, or tactical investing among sectors, to name a few. With their low cost, transparency, and easy access to a wide range of asset classes, ETFs have significant advantages that have benefited millions of investors. For example, many investors, both retail and institutional, have found enormous value in being able to observe the price of the ETF during the day and to use trade type orders such as stop loss or limit orders in an attempt to control the price at which they transact. Against this backdrop, several market issues converged on May 6 to affect prices for U.S. equities in general and ETFs holding U.S. equities specifically for a period of approximately half an hour during the afternoon's trading. We note that ETFs holding U.S. fixed income securities and non-U.S. equities were largely unaffected and generally traded at prices within normal ranges of underlying assets. Asset values. Many ETFs holding U.S. equities, however, did not. In our view, 4 different factors simultaneously contributed to market prices for some ETFs diverging from underlying asset value. First, there was the sudden market free fall in U.S. equity prices, which preceded the fall in ETF prices and caused market makers in ETFs that seek to track benchmarks heavy in the falling stocks to have difficulty valuing the ETF's underlying assets. Second, anxiety over potential trade cancellations caused liquidity providers to fear that normal ETF hedging strategies would be interrupted, which caused them to pull back from bidding for ETFs. Third, there was market fragmentation where exchange protocols and order routing rules increased selling pressure. And finally, there was unintended selling because of the stop-loss orders that were triggered, which increased the volume of sell orders on ETFs. These stop-loss orders, which turned into orders to sell at market prices, were executed significantly below trigger points due to the speed of price freefall. While we believe the final impact on investors was relatively limited due to widespread trade cancellations, there was nonetheless an impact. To better understand exactly the effect on financial advisors, we at BlackRock's iShares ETF business recently commissioned a survey of retail financial advisors in late June. We commissioned the flash crash perception study to learn from financial advisors, one of the largest groups of ETF users, what they think about the market event that affected individual securities and ETFs as a category. The survey revealed that the majority of advisors were minimally impacted by the market disruption, and they believe that market structure issues such as an over-reliance on computer systems and some types of high-frequency trading were the primary drivers of the crash. Stop-loss orders, market makers, and exchange routing issues were seen as secondary issues. As it relates to the macroeconomic environment, the majority of advisors surveyed expect current market volatility will either increase or remain at today's level over the next 6 months. Furthermore, and perhaps disappointingly, those surveyed anticipate an event similar to May 6 will likely occur again no matter what solutions are adopted. The survey also indicated that most advisors' accounts were not impacted by the events of May 6. Of those accounts touched by the volatile trading on that day, the most common cause was a stop-loss order triggered by the flash crash and executed at a significantly reduced value, which happened to about a quarter of the advisors surveyed. Regardless of the cause of volatility, economic or structural like the flash crash, advisors identified ETFs as the best investment vehicles to navigate a volatile market environment, followed by bonds and mutual funds. The survey findings underscore for us at iShares the importance of strong market structure reforms to help prevent future market disruptions, some of which we've already spoken about this morning. We believe those reforms should include uniform circuit breakers for stocks and ETFs across all exchanges, making exchange trade error cancellation rules less arbitrary and more transparent in a manner that does not discourage liquidity providers from providing liquidity at times of market stress, clearer guidelines for intermarket order routing rules, replacing stop-loss orders with stop-loss limit orders to specify a limit price for caller, and expanding the role of lead market makers to ensure orderly market functioning, particularly at times of market reopening. We believe these reforms would represent a strong step towards preventing market disruptions like the one of May 6 in the future. We at BlackRock look forward to working together with members of this committee and the staffs of the SEC and CFTC on this important issue. Thank you again for the opportunity to speak today.
Thank you, Noel and Charles. I just wanted to ask, because I apologize, it may all be, if we have all of your written things electronically, it facilitates putting it up on the web, and I just don't know if we do, but I was just asking if we do, then we can, the public can see what your comments are too. Charles.
Hi, Chairman Shapiro, Chairman Gensler. Thank you for having me. I'm Charles Ropelot. I'm Vice President with the American Association of Individual Investors and editor of the AAII Journal. We represent 150,000 individual investors. We're a nonprofit organization focused on giving individual investors education and information about investing. Our members are typically have an intermediate level knowledge of investing. They typically hold either a college degree or an advanced degree, and the majority of them trade online through discount brokers, most of whom do follow a long-term strategy, though we do have some who trade a little bit more actively. Many individual investors continue to have questions concerning the May 6 flash crash. They are unsure about the procedures that caused stock prices to become so volatile. They are worried that solutions have not been established to prevent similar events from occurring in the future. They wonder about how much control over the movement of stock prices has been ceded to complex software programs that trade within milliseconds. They don't understand how market makers could have allowed some highly liquid stocks to fall to a penny per share. Most importantly, they are asking where the protections are for the individual investor. The biggest impact of the flash crash, the events on May 6, from the standpoint of the individual investor, was not the effect it had on their brokerage account balances, but rather the effect it had on their confidence. They are concerned that unusual volatility, such as the large price swings that transpired, could occur again. They are also worried about the possibility of a buy or sell order, especially a stop order, not being executed in an orderly fashion.
Thank you very much. Kevin?
Thank you, Chairman Shapiro, Chairman Gensler, and members of the Advisory Committee for the opportunity to speak here today. My name is Kevin Cronin. I'm head of global equity trading for Invesco, and I appreciate the opportunity to speak to you today about the events of May 6th. Invesco is a leading global asset management firm operating in 20 countries with assets under management of approximately $560 billion. I'll try to be brief in my statements. I have, however, posted a more detailed statement for the record. I'll spare you any of the drama. We believe that the crash that happened on May 6th was, in large measure, the result of flaws and inefficiencies in the current U.S. market structure. Specifically, the flash crash revealed the need for updated market-wide and stock-by-stock circuit breakers, effective and transparent procedures for resolving clearly erroneous trades, a review of the risk and effectiveness of market orders, alignment of the inconsistent practices and procedures used by various exchanges to address major price movements, an examination of the responsibilities and obligations of registered and unregistered market makers, and better coordinations across all types of markets. Removing all instability and volatility from the equity markets is neither possible nor appropriate. However, establishing mechanisms to address extreme price moves in the markets and volatility related to inefficient market structure will be critical in preventing a repeat of the May 6 flash crash. As such, Invesco supported the single stock circuit breaker proposals as a mean to mitigate the impact of sudden market volatility. Similarly, we strongly supported amendments to the rules relating to clearly erroneous executions to clarify the process for breaking erroneous trades and to provide uniform treatment across exchanges for clearly erroneous execution reviews. However, we believe the whole notion of taking trades off the tape is generally detrimental to investor confidence. We believe we would propose, rather, that exchanges clearly define and articulate the parameters to constitute erroneous trades and then program their systems to detect and reject trades outside of those parameters. We believe uncertainties surrounding clearly erroneous trades and the risk associated with entering orders during the drop in the stock prices very likely contributed to the rapid and dramatic market decline on May 6th. As was clearly illustrated by the events of May 6th, there was also a vacuum of liquidity. And in this vacuum of liquidity, small market orders can have an outsized impact on the prices of securities. This vacuum was created when a massive wave of sell orders hit the markets, triggering liquidity replenishment points, LRPs, on the New York Stock Exchange. These LRPs, or speed bumps, resulted in the NYSE going into slow mode. Subsequently, NASDAQ and the other exchanges declared self-help against NYSE ARCA. This declaration of self-help allowed the other exchanges to essentially ignore the quotes on NYSE ARCA. Thus, as various exchanges were determining where to route their orders to fulfill their Reg NMS obligations, they could do so without consideration to NYSE ARCA. At the same time, market makers and liquidity providers were widening their quotes or getting out altogether as the quote data they were receiving became less reliable. As a result, small market orders and stop-loss orders which were triggered became market orders and left to execute against the very limited amounts of liquidity that was posted on other exchanges or market centers. In some cases, the only available quotes left were the so-called stub quotes of some of the market makers. As an institution, we have long understood the significant risk of using market orders, particularly as the market has become more fragmented, and as such, we have not used them for some time. In light of events of May 6 and the continuing issues small market orders have had in the market, obviously recently with the triggering of certain circuit breakers in stocks like Cisco and Citigroup and others, Invesco recommends that exchanges and broker-dealers only accept market orders which have collars on them. A collared market order would only allow execution of the order within a certain percentage of the reference price, for example, 3% of the last sale. We would also recommend similar treatment for stop-loss orders. This would give investors some level of protection from the market, or from the impact rather of market orders that market orders can have in current environment, and would likely reduce or altogether eliminate the issue of small share amounts triggering circuit breakers. We believe that the self-help provision under Reg NMS needs to be reviewed. This provision was put in place many years ago to prevent manual markets from unnecessarily slowing down trading. It was also conceived at a time when there were very few high-frequency trading firms and fast executions were defined in seconds, not microseconds or milliseconds. The events of May 6 also illustrate the interdependency of equity, options, and futures markets, particularly the connection between price discovery for the broader stock market and activity in the futures markets. Invesco strongly supports a more robust discussion and examination of the linkages and interdependency of the equity, options, and futures markets, and whether rules need to be made more consistent across all types of markets. The role of traditional liquidity providers, such as market makers, has taken on more significance given the events of May 6, as the sudden absence of liquidity in the markets played a critical role in the severe price declines. Several ideas have been put forward to improve the operation of market makers that are worthy of further consideration, including increasing obligations surrounding best price, depth of market, and maximum quoted spread obligations. In addition to traditional market makers, an examination of other liquidity providers, particularly high-frequency traders, is warranted. While Invesco believes there are many beneficial high-frequency trading strategies and participants which provide valuable liquidity and efficiencies to the markets, we also believe there are some strategies that could be considered as improper or manipulative activity. This highlights the need for the industry to better understand high-frequency traders and the practices of high-frequency trading firms. While it is important for the advisory committee to study the impact of market orders, LRPs, the declaration of self-help by exchanges, market makers, and other issues we've mentioned, we believe a more fundamental consideration is warranted, and that this is whether the current market structure has become too focused on the speed of execution over all other factors. At some point, we believe that speed and price discovery have an inverse relationship, and this dynamic needs to be well understood. I thank you for allowing me to participate, and I look forward to answering any questions you might have.
Thank you, Kevin, for those remarks. Some provocative. Chris.
Thank you. Chairman Shapiro, Chairman Gensler, and members of the Joint Advisory Committee, thank you for the opportunity to participate on this panel concerning the May 6th market event. I'm Chris Nagy, Managing Director of Order Routing Strategy for TD Ameritrade. TD Ameritrade, based in Omaha, Nebraska, was founded in 1975 and was one of the first firms to offer negotiated commissions to investors following the passage of the 1975 amendments. Over the course of the next 3 decades, TD Ameritrade pioneered technological changes such as touch-tone trading and internet investing to make market access by individual investors more affordable and transparent. While TD Ameritrade clients predominantly trade equities and options, recently we began offering clients the ability to trade futures and Forex through our thinkorswim division. TD Ameritrade has long advocated for market structures that create transparency, promote competition, and reduce trading costs for individual investors. As technology rapidly advances, it's ever more important that the regulators complete a comprehensive review that they are now undertaking to ensure our U.S. market structure remains amongst the greatest in the world. It's our intent to present these comments on behalf of our 7 million clients based upon the views they regularly express to us and our experiences in providing services to them. While the U.S. financial markets have experienced precipitous market declines during a single day, including the most famous 1987 market crash when the Dow Jones dropped 508 points, the May 6th market event in many ways was unique. First, in the speed of the decline. The market whipsawed 1,000 points in just 10 minutes. Second, the market decline was somewhat random and uneven, causing over 90% temporary declines in some stocks, while others were relatively unchanged. Third, and perhaps most importantly, it appears that the very nature of how the U.S. markets are structured was a contributing factor to the precipitous decline. Although the causes may never be completely identified or understood, they appear to be, in part, partially lie in the dispersed structure of the U.S. markets and the market's increasing dependence on liquidity providers who have no affirmative obligations to maintain two-sided quotes. Regardless of the exact cause, it's clear that the May 6th market event has had an impact on investor psychology and their trust in the markets. How do you explain to an investor that a company with a market capitalization of $26 billion that trades at $40 per share and seconds later trades at a stub quote of a penny? Obviously, investors and on the receiving end of executions filled against those stub quotes are going to question the fairness of the markets. Similarly, misgivings were voiced by investors who had executions that were less than 60% away from the market. Again, how do you explain to investors that a trade 61% away from the market was deemed erroneous, but orders filled anywhere up to 59% away were not? And how do you explain to investors that some trades, even though they were more than 60% away, were busted while others were not? From our perspective, the answer for these clients will lie in the actions we as an industry and the regulators now undertake. Specifically, we may need to adjust the way in which the U.S. markets are currently structured so that investors can trust that the price displayed to them is valid, so that they have the confidence in the liquidity available, and so that they do not believe the markets are somehow rigged against them. The May 6th event was a wake-up call, and one that requires a comprehensive response. Today's panel is just a small part of the appropriate response. It's a response that requires looking across the equities, options, and futures markets and approaching regulation holistically. It requires addressing not only the imposition of circuit breakers, but also must include a review of dark pools, flash orders, access fees, high-frequency trading, and naked access. For investors, we think the right approach is a combination of the following. First, we agree with the adoption of the circuit breakers as a first good step. The regulators correctly identified an issue and took quick action to ensure trading took a pause during extreme market movements. But as everyone who's had to fumble around in the darkness of their basement, searching to reset a circuit breaker knows, circuit breakers are a fail-safe and do little to address the underlying cause of the problem. Second, TD Ameritrade believes that the regulators need to find a way to incentivize market centers to stay in the market, maintain two-sided quotes, and most importantly, to post size regardless of the market environment. The firm has noted previously that the May 6th market event demonstrated that today's markets contain many players who use their liquidity opportunistically, applying it when it's in their favor, but pulling it during times of market duress. Third, and particularly in the equities and options markets, the SEC should proceed with all due speed to move its concept release on market structure to a proposing stage, while at the same time addressing issues like co-location, access fees, flash, and naked access. Finally, as to the specific allegation that retail market orders and stop orders contributed to the downturn, I can tell you from TD Ameritrade's perspective, such orders are important to our clients, and looking at our own data, we do not believe that there is any factual basis to assert that these types of orders contributed to the problem. In fact, TD Ameritrade's clients' market and stop orders were within average daily volumes on a percentage basis. Prohibiting market and stop orders would be a significant adverse, misguided, and unnecessary overreaction to the underlying cause of the May 6th market event, which would unduly deny retail investors the access to the markets they enjoy today. I look forward to answering any questions you may have. Thank you.
Chris, thank you very much. Pamela?
Good morning. My name is Pamela Craig, and I am the CFO of Accenture. Chairman Shapiro, Chairman Gensler, Commissioners, and members of the Advisory Committee, Accenture appreciates the opportunity to share our perspective on how the trading events of May 6th impacted Accenture and our investors. Accenture is a global company with $22 billion in annual revenue. We have 190,000 employees, 32,000 of them in the United States, and our market cap is $29 billion. Over 70% of our shares are held by institutional investors based in the United States. Just under 20% are owned by current and former employees. Of our current employees, 25,000 are shareholders, 62% of whom are in the U.S. We recognize that there is still not total clarity about what happened on May 6th. We do understand that there was seemingly a perfect storm of economic news around the globe, a reduction of liquidity in many securities, unusual trading volumes, and some technology challenges. Based on what we've all witnessed in the markets that day and since then, there's every reason to expect that this can happen again. We strongly believe that in times of market stress, all markets should operate under the same circuit breaker rules in order to promote orderly markets and investor as well as business confidence. We have a unique perspective on the trading events of May 6th. Between 2:40 and 3 o'clock p.m., the price of Accenture stock went from $41.01 to 1 cent and back again, and then closed that day at $41.09. Between 2:40 and 2:46 p.m., Accenture shares fell from $41.01 to $38 as liquidity evaporated in the equity markets. This triggered an Accenture-specific circuit breaker at the NYSE, the LRP. At that point, the NYSE stopped its own electronic trading in our stock briefly to go into slow mode so that market makers on the NYSE floor could then line up an orderly matching of trades. During this transition of about a minute, trading in our stock was temporarily halted on the NYSE while orders had the option to execute on other exchanges. A few small sell at market orders totaling just 10,400 shares altogether, and all in a 10-second window, were directed to other exchanges. These exchanges were not coordinated with the NYSE, and expected market making did not occur. These orders included 19 trades of 100 shares, each trading at a penny. Trades below $16.40 were subsequently busted. None of the canceled trades were on the NYSE, where the low trade for the day was, in fact, $38.75. This erratic trading rattled overall investor confidence in the market, but specifically affected our investor base, including the thousands of our employees. Accenture employees are granted equity compensation and participate in our employee stock purchase plan, which provides them with a way to invest for their future and participate in the success of our company. 51% of our 32,000 U.S. employees participate in the plan. After May 6th, many employee shareholders were concerned about why our stock was affected versus other large-cap companies. We believe this sentiment is consistent with the concerns of retail investors. The joint CFTC-SEC staff report on the market events of May 6th also highlighted Accenture trading on that day. This brought further attention to the company. In addition, the partial trade cancellations have had an ongoing adverse effect on historical trading records. After May 6th, the exchanges and FINRA canceled trades in stocks between 2:40 and 3 p.m. that were more than 60% away from the last trade at 2:40 p.m. This arbitrary pricing threshold caused the 52-week low for these stocks to be misleading to investors. It is disappointing that the 52-week low for Accenture stock is currently $17.74, which obviously reflects the malfunctioning of the market-making process on May 6th and not the true 52-week low. The low point on the New York Stock Exchange on May 6th was $38.75. We commend the SEC, the exchanges, and FINRA for proposing new rules for canceling clearly erroneous trades. We support efficient and fair markets, and we also understand that the markets need to be governed by some rules. Increased competition with more and better technology all the time has been good for the markets and has driven down the cost of trading. 9 years ago, a substantial majority of our trades occurred on our primary exchange, and today that's only about 45%. So the rules need to be updated, modernized, if you will, so that they adapt to how the markets are evolving and continue to work as intended. If we expect today's markets to function well and to keep up with increasingly sophisticated trading technology, then the rules need to be clear, coordinated, and consistently implemented. If something similar to the May 6th events happened again, investors could be deterred from investing in our company, even though it would have nothing to do with the strength of our underlying business, but instead be due to a market glitch. We therefore urge the SEC to adopt the exchanges and FINRA's proposed rules to expand the circuit breaker pilot beyond the S&P 500. Expansion of the pilot to include companies in the Russell 1000 would provide protection for investors in companies such as Accenture that experienced severely erratic trading on May 6th, as well as provide regulators with a broader sample. In the end, while we understand it's good to pilot something with a smaller sample, it does not make sense to perpetuate different rules for different issuers. We firmly believe that changes are needed to limit the impact of market breakdown on issuers, their shareholders, their employees, and business and investor confidence generally. As noted above, investors in many other companies remain unprotected by circuit breakers, and we urge you to promptly expand the pilot to protect these investors and increase confidence in the U.S. equity trading markets. Thank you for inviting me to participate today, and I welcome any questions you may have.
Thank you, Pam. Thank you, all the panelists. And then I'm going to turn to our committee members. We're going to do this in a sort of informal way. So who wants to start with a question, or Maureen, ladies first.
There we go. Thank you. I'd like to address this question to Mr. Cronin. You talked in your discussion about the need for collared orders, in particular collared market orders and collared stop-loss orders. How exactly would a collared stop-loss order work, however? I'm trying to understand the logistics of sort of guaranteeing an execution. It would simply just not, if it went through the collar, it would simply be voided. Is that the argument that you would like to put forth?
Yes, I think so. As hopefully I was able to describe, a market order today, given the fragmented nature of the market, has to be understood in the context of what a market really means. Right? So much of the liquidity that's available today is either hidden or available in places that some orders don't have access to. So our concern is that, and I suspect Pam shares the same concern, that small orders, if not carefully governed, market orders can have a big impact. And so what we would propose is that we have market orders that are allowed to continue into the system. I mean, it is easy to hit the market button, and I suspect quite a bit more difficult to put a limit price in. But so if we were all in agreement, what would happen is any market order would have a reference price as soon as it came in. And depending on what would be a reasonable percent, I think 3%, it would not execute if it was unable to find a price within that price band. And this is something that has worked in various forms and fashions in other exchanges, particularly the CME, and I think has been very, very beneficial. I do believe also it would have the knock-on effect of getting rid of this nefarious problem that has erupted here the last couple of weeks, which is small trades causing circuit breaker elections and halts in stocks like Cisco and Citi and others that really have no business being halted for such small share amounts.
Could I just say one thing with respect to that? This is an issue I'm really interested in or pursuing, and so if the committee would particularly devote some thinking to this alternative. Circuit breakers were the thing we could do fast and get in place and have a calming effect on the market. And while we have had a number of triggers, I'd be interested to know if anyone thinks they've caused any harm to the marketplace. It's not my perception that they have, but to get some thoughts from the committee on this issue in particular over the next couple of weeks, I think would be really helpful to us.
And just staying with that, I noticed that I think Chris probably, though you're sitting next to Kevin, might be miles away in terms of this issue. So I'm curious, do you think the collared market orders, whether it's up and down 3% or 4% or any number, would work for retail investors?
Let me take both of those because we're talking about stop orders and we're talking about market orders, right? So let me take the stop order issue first and talk a little bit about that. At our firm, TD Ameritrade, we actually do offer a sort of a colored type of order through our technology. It's what we call a trade trigger. And effectively what that allows the investor to do is just a stop-loss limit price. However, that limit price is going to track the underlying price of the security. Now, once the trigger event hits, then that order goes into the market as a stop order. The problem that you have with collars, and I think it's a very intriguing idea, don't get me wrong on that. I actually leaned over to Kevin and told him I like a lot of the aspects of the CME limit up and limit down program. But the problem with some of the stops and some of the market orders, by just eliminating those in the totality of the marketplace, would have an adverse impact on retail investors for the following reason. And here's why. Retail investors, and I said this on June 2nd, and I think we put it in a couple of comment letters, retail investors really invest in the market at kind of 2 points in time. One, it's in the morning, right when the market opens. Ironically, the circuit breakers don't start till 9:45. So why do retail investors invest at right in the morning? It's because they work all day. They go home, they eat dinner, feed the kids. Then they sit down and they get to their investment portfolio and redo their investments. We see an awful lot of that. At my firm, we see 10 to 15% of our trading day occurs at 9:30 in the morning, even though the circuit breakers don't go into effect till 9:45. Stop orders, likewise, are important to retail investors for a lot of the same reasons. They want to protect the downside of their security. So if in a very precipitously declining market with a lot of volatility, if there are collars in place and it happens to miss that collar event, it's not going to be a very happy retail investor at all, whether off on their family vacation, which is typically when things like that would occur, right? So That's the problem that you have. I think what we need to look at is addressing the structure of the markets more. Had the markets not dropped, 900 points in 10 minutes, I don't think we'd be sitting here today. But there was a complete evaporation of liquidity in the marketplace. And I think that in itself is more concerning to investors rather than missing their stop price by $1 or $2.
The only thing I would say, Chris, is that the two are very interconnected, right? So liquidity providers are generally watching things happen and making decisions based on that. So as bad quotes start to get into the system, as clearly erroneous trades get into the system, their ability or interest in making markets goes that way with it, right? So what I would propose is, I get how investors might have an interest at times of heightened dislocation in the market, but is that particular instance of all the times that they invest, which I would suspect is a relatively smaller percentage, X some of the volatility we had maybe a year and a half ago, but it seems like to me that the protection that they would get generally from a collared order would certainly exceed any material consequence of not being able to sell at the market in sort of worse times. I would also offer that this doesn't preclude anybody from putting a limit order in that's well below the market, right? So I suspect that an investor who got the penny, Pam clearly was irritated. I suspect the guy who sold it at a penny was irritated too. There are basic procedures that could have been put in place that would have precluded that bad event for not only that seller of the penny, but also for Accenture as well. I think it's a sensible thing to do.
The one thing I'd say about the aggressive limit orders, and Mr. Ketchum will know this, there are actually FINRA rules that prevent hyperly aggressive price limit orders into the market, so we've got to have certain parameters within our system to prevent a lot of that. So I think that would need to be restructured if we were going to go down that road. But the one problem that you have with that, though, is that what happens if that investor misses that collar, right? That's the quandary. And that's where I think we really need to take a look at the structure of the market, the liquidity in the marketplace. Look, during times of duress, like we saw on May 6th, like we saw in 87, like we saw, that Friday the 13th crash in 88 or 89, they're very similar in that the market went down, right? But they need to go down in an orderly fashion. In 2008, when the market started to decline into 2009, that was pretty ordered. People were entering market and stop orders, and things worked very, very well. What happened on May 6th was unique, and it was different, and that's the problem that we need to fix.
I think I'd actually like to build on that, if I could, just from an advisor's perspective, because I do agree. Clearly, it would be nice to get something in place, from a perspective of the callers or something else. But when we did our survey just a little over a month ago, over 60% of advisors said they would continue to use stop-loss orders. Over 75% said they would continue to use market orders. And I think, to use an anecdote, I was in front of a group of advisors about 3 weeks after the crash, and we talked about, do you think it's a good idea to use market orders? Already at that point, there was the consideration, do we get rid of stop-loss orders? And the sentiment from this group of 50 advisors was a little bit of, be careful of fighting yesterday's battle. If this had been a day that truly was going down 1,000 points in the market or more, which some of the models were saying, because there had been a true market event, they would have been pretty upset if they had had stop-loss orders in place that got blown through the collar, right? They didn't get executed because the market was moving so quickly, so a defensive strategy that they wanted in place as investment professionals that are monitoring the account, they wouldn't have access to that. So I don't think it's something we should ignore. Clearly, the issues that we saw of small market orders pushing through the order books was an issue, but it's part of that larger issue of all these interlinked events that came together. So we should be careful of trying to solve the bigger problem and not just solve the May 6th issue.
So to that point, Mr. Archer, I think you actually suggested what arguably could be an alternative to collars, which is to shifting the existing pilot with regard to pauses to rolling limit ups and limit downs, which I guess has arguably two benefits. One, as Chairman Shapiro noted, that if you are concerned with respect to a single trade stripping beyond the pause level, since a single trade can do that, a limit up addresses that by not allowing trades in any market below the limit. Secondly, it doesn't require a pause for 5 minutes if there's buy interest or the future reacts and bounces, so that you don't hold the market up in those circumstances. Yet you do build in essentially on an organized basis across all markets in assurance that stop-loss orders don't strip past the limit, or at least provide a firm for a period of time a chance to react to those stop losses before they trade again. The downside, and maybe I can address this to anybody who wants, but certainly to Noel and Kevin and Chris, the downside of limits in a terribly fragmented environment like the U.S. securities markets is that they're only uniform in some ways. They're uniform in ensuring trades don't go below them. They're not uniform as to when the marketplace starts up. And there's always the potential you can have a single random bounce trade but still have serious sell pressure, and you lose the opportunity to have the option that the pause provides from the standpoint of trying to pull together buy and sell activity. And you also result in one market starting up at a different time, albeit not probably significantly different than the other markets, since that market will know when its order hits. So I guess my question would be, is that a fair reflection of the upside down, and why, given the pros and cons of it, do you think that's a better solution where we sit with respect to pauses and a possible collar?
And just in answering the question, so the public might not know what a rolling limit, what was the thing you called it?
Who knows what I said?
Whatever. In your answer,
you know far more about limits than I do.
If you're in your answer for the public, try to just say briefly what
Right.
the suggestion is.
So first, it was very articulate, Rick, for you, which was excellent. So,
which is always a miracle.
Yeah,
but
that was great. But that aside, I think that there has to be a bifurcation. You have circuit breakers and a collar type arrangement, or you go to this limit up-down. And what that would mean is that a stock at any point in time would have a percentage that it would be allowed to trade up or down, and to reach that limit, if it were a sell, for example, it could only trade down to that limit price and no further, right? For, say, 10 minutes, like on CME, it would trade down at that limit price. It has the opportunity to trade above that, but it can't trade below it. If after the 10 minutes it were to continue to trade at that price, there'd be a 2-minute halt, again, using the CME as a model, where all investors hopefully would take into consideration exactly what had happened. The 2-minute halt would end, and then the stock would be free to trade below that first limit price. You might find that there would be a second limit price that would be appropriate, and you would go through the same sort of machinations again. But
Kevin, after the halt, would you have the listed market reopen the stock, or would all markets simultaneously try to reopen the stock?
I think the devil is in the details, and that was what Rick was alluding to. I would personally prefer that it would be a coordinated event, right, like the NASDAQ Open, where you have multiple players putting indications in, and you have an open. That, to me, makes more sense. You get all buyers and sellers together, and you don't get these dislocations in one exchange versus the other. To me, this fundamentally gets to the issue of some of the problems we have today. Markets are not aligned. People are doing their own thing, and when you get to that, even if you come up with sensible solutions, to the extent that things are not all linked together, the beneficial outcome, which we think could happen, won't if they're not linked appropriately.
Maybe one. Oh, I'm sorry. Please.
Hey, Kevin, let me follow up for 1 sec. So the cynics say there are 40 trading venues for a guy like you, not for somebody who trades through TD Ameritrade and doesn't know necessarily where it happens. Do you think that coordination can occur for dark pools and other trading venues to make the net effect that you want out of that type of limit up, limit down? That's been one of the big reactions. Is it's easy to do in one exchange in Chicago, it's tough to do in the equity market. What's your sense of it?
Well, it would be tough to do, for sure, but I think most institutions, clearly Invesco and I'm certain Vanguard and BlackRock and others, would take the opportunity to make sure that they were in the right venue to ensure that they were protected as that stock reopened, or to source the liquidity wherever it was appropriately sourced at that time. But clearly it keeps getting back to this root issue. We have a very fragmented market. Different market centers in large measure are doing their own things, and to the extent that that's not better coordinated, this is going to be a very, very difficult thing to fix. But I think generally, and I don't mean to speak for our peers, we would be very supportive as an industry to try to get to a better location where things are linked better, where we wouldn't have to, for example, hide so much of our order flow, where we would have more incentive to post liquidity, and some of these dislocations perhaps wouldn't happen, certainly not to the magnitude that they have recently.
Chris?
Just a note on the circuit breaker. So we as a firm are fans of this kind of trading band idea that the CME's been running for a long time. It's been in place for, I think, 20 years. It seems that it's worked very effectively with the limit down strategy. Halting and stopping trading is always a bad idea because of the devil in the details of the opening process. I said this in my speech that the circuit breaker rules don't kick in until 9:45, and here, we're going to talk about trading in milliseconds today. Yet the average opening takes, markets open at 9:30. All stocks aren't usually open till like 9:31, 9:32. It's kind of an ironic situation to be in, and we've also noticed that with the circuit breakers. The problems that we've had with those have been in the reopening process. If you look at Citigroup, for example, it was triggered on an erroneous trade. The opening process that occurred after that wasn't equal amongst all the exchanges. One exchange opened before. Genzyme, which was about a week ago, same exact thing there. That was triggered off of another erroneous trade, but then it was an erroneous price for the opening price that triggered it to go into a halt again. And then Hewlett-Packard, which we had just the other day, that was a manual issue from one of the exchanges that caused that to go into a regular trading session when it should have been extended hours. So a lot of the reopening process on these tend to be very difficult. And I'd also add, and I think this goes to some of Pam's comments, in that there's not a lot of transparency when you see a halt. If you're a retail investor looking at quotes, be it on Ameritrade or Google or Yahoo or one of the quote providers out there, it doesn't clearly say that this stock is in a halt-type condition. And that's a confusing environment for the investor. I think when you get into some of the trading band issues, then when you start harmonizing across the different products and agencies, be it the minis versus an equity, but then you can also tie that, I think, into a lot of the ETF products, which had a lot of the erroneous issues. So that's kind of my thought on the direction that we'd like to see the overall circuit breaker system go.
One topic sort of leads to another here, and I would say that from our perspective, as we've looked at that, we're deeply concerned about the reopening of the securities. Closing them is only half the story. Getting the logical restart. If there's a 10-car pileup, you really need the state trooper there to get traffic moving in the right way again. When we think about the role of lead market makers, and we think about even the role of the specialists going back, many, many years, feels like many years, 5, 6 years now. You can't go back in time. In this rapid environment, you can't go back in time, but you do, there was a benefit to having someone there that regulated the activity that was happening on the exchanges. And we do think as we look to balance obligations with incentives to some of these types of players in the marketplace, looking at things at, making the lead market maker responsible for the orderly reopening of the markets if there's a stop could be the type of incentives that then is the other side of the obligations that they might have to step up into to be lead market makers on the securities. So looking at the interlinking of those issues at the time of reopening of securities we think is pretty important.
Maybe to that point and sort of the broader issue, since there was difference of opinion suggested by a number of panelists on market maker obligations. Start on one side, Mr. Mendelson, you indicated you thought market maker obligations of any sort will never solve anything, and certainly you're right that no one's ever seen a market maker obligation that encourages somebody to go off a cliff in a steep downturn, although I note that I think if you go back and look at most of the studies, it would show in the days in which there were more incentives to market making, those people ended up net long in those days, and certainly net long during the time frame in which markets were going down. But I guess the question would be there's kind of two pieces of market obligations. One just sort of is another piece of addressing Accenture and Ms. Craig's concerns, and that is addressing stub quotes and at least requiring a market maker to not have a two-sided quote outside of the pause level. Would you think even that so skews the incentives that you wouldn't be in favor of it?
No, I don't. I think that's probably a little bit different type of story. Right now, there's some people are obligated to provide stub quotes. I don't think that's very helpful. I think it's almost better if there was no quote. So I don't think a penny bid in Accenture stock is. I don't see what economic function that serves.
Thanks. And maybe on the other side, Mr. Archer, to your point, and Kevin and Chris, I know you both suggested you favored some increased incentives and increased obligations from a market-making standpoint, at least I guess for lead market maker types. Now, I guess my question there would be incentives as in what? Obviously, we have a very fragmented, commoditized set of exchanges that have relatively little pricing power and relatively little ability to attract. Now, one market competes on market-making obligations and provides a significant incentive parity, and that would be the New York Stock Exchange. The other markets choose not to provide that significant incentive. But if there was a view of something more than just getting out of the stub quote problem and if in fact having narrow quotes near the requirement to generally be around the best bid and offer, and then requirements to layer the book on both sides, which is what I sort of see that would not create miracles in bad times, but probably would avoid having single, relatively small orders stripped through the book. That does change the cost-benefit issues of market makers. What incentives do you think or make sense to you as non-market making participants to encourage that?
So I will tell you that market makers as a whole are very, very important to us at TD Ameritrade because what they do is they provide the retail investor consistency in the marketplace. So that if there's not necessarily liquidity available at the inside, that market maker will generally step up and fill the entirety of the order at the inside so that client got the price they saw when they entered the order. In terms of incentives, I don't think you can just, and there's been a lot of talk about, let's create rules where, we'll get rid of stub quotes by just forcing market makers to quote right inside of the 10% threshold, say, and that should do it. The problem I think there is, and we've seen this over the past decade, is market makers are fewer and fewer and fewer in number, and a lot of the growth in overall liquidity providing has been in more opportunistic liquidity. I'll be there as a fair weather trader, but if it turns dark and gloomy, I'm out of here. I read about it in the journal every day. So I think in order to counter that and in order to get incentives in the markets, I think there's a couple of things. One, I don't think, unfortunately, this committee has the power to do, but I think it would be a very good one, which would be tax incentives to liquidity providers in the markets. I think that would be very powerful. Similar to how in some products on the CBOE, for example, where you've got 60-40 tax treatment on particular products. I think that's very appealing. The second thing that I think this committee does have the power to do is when you take a look at market data, the overall infrastructure of market data and what can be done with market data incentives in the marketplace. There appear to be, and when we begin addressing this issue in a very large fashion, there appears to be a very large dislocation in the cost of that data and getting that data by some firms versus other firms. And we don't see a real fair allocation of the overall infrastructure of the data. And I think that's a very good resource to take a look at to see what opportunities can be created in the marketplace. Finally, I'll say that in our markets today, we incentivize the quote, not the depth. So if you look at all the market structures that are out there, all the different ECNs, all the different exchanges that are out there, we provide a lot of incentives to post a limit order, right, but not for size. And there are ways that you could change that structure so that you're incentivizing size rather than just the limit. And I will say, I think Reg NMS did a wonderful job of making the markets more electronic during that time, but I do think the overall notion of access fees in the markets should be looked at as well, too.
So, Rick, I guess there's two ways to look at this. First, it's easy to say that the market-making function failed at this particular point in time. It had issues, to be sure, but I do think that as you look at different types of markets that are being made, for example, in ETFs, the mechanism works very well. The incentives are in place. If you're able to understand what the value of the underlying securities in a basket are, at the same time understanding what you could sell the ETF for example, you have this ability to make a reasonable market, and there's risk that's assumed, and you have the ability to make money. That works. It doesn't work when they get bad information and they have to pull away, as we clearly saw. But I think that mechanism generally is in place and works well today. We want to be very careful that that is not upset as we proceed. That said, I think if you look traditionally at the market-making function, market makers have been given some level of advantage. And with that advantage, there was an expectation that there was a commensurate amount of obligation, right? As we look at the market making today, there are some firms that clearly are designated market makers, broker-dealer, registered as market makers. But as we went to pennies, the spread mechanism that used to incent market-making activity went away. And as we had this influx of new participant, i.e. high-frequency traders, the ability for traditional market makers to participate or compete has been severely compromised. So what we have today, I think, is a group of investors, oh gosh, here he goes again, with high-frequency traders who have an advantage, and they don't have a commensurate amount of responsibility. And so I ask, is it fair that they have direct access to exchanges where the rest of us are looking at CQS? Is it fair that they have co-location and have maybe 100 or 200 millisecond advantage? Maybe the answer is yes. Maybe people can intellectually argue the point away. I happen to believe that there are real advantages that are conferred, and as such, there should be real obligation. If not, everyone should have the same, quote, access, which would be CQS, and co-location would go away.
Can I comment on that?
Yeah.
Because I also want to let our panelists ask questions. So, but why don't you go, and then Rob's going to ask something.
Sorry. We're, at our firm, we track our transaction costs, and we have for a history of this over a very long time. And our transaction costs have gone down steadily. In the old days when there were market makers, and many years ago I used to sit next to a very large group of market makers, there was a group of participants with very significant advantages. The result was that investors paid significantly every minute of every single trading day. And when there was a market disruptive event, it didn't help us. When in 1997, I think it was October 27th, we had a crash. It wasn't like the 87 crash, but I think we were down about 7.5% in the S&P 500, something like that. Market makers weren't there to buy your stock at a bad price, and they're not going to be now. And so what we have is we're hoping that by providing special incentives or obligations or preferences for market makers, that they're going to do something that they simply aren't going to do. They're not going to stand there and buy stock at the wrong price. On the other hand, on an ordinary basis, the system today allows us to trade more cheaply in more stocks than ever before. So while the market-making function today is, Chris just described as opportunistic, I don't think it is opportunistic. They're always there. On a previous panel before this committee, one participant suggested that obligations that they have to be there 97% of the time. Okay, I would say with no requirement for obligation, certainly electronic market makers have been present this year, which we would call a bad year, I think, 99.975% of the time. So in the 150 trading days so far this year, there's probably been 20 minutes where some of them faded. I don't think an obligation where 97% of the time you have to be there is in the slightest bit helpful. It won't change a thing.
I don't think
Let
anybody
me
is-
just, Kevin, I apologize because I'm conscious Rob just had a question, and so I'm just trying to...
I guess I was wondering, when we talk about incentives for market makers, does it make any sense to think about these as being time varying? In other words, there are some times when you would especially like to incent market makers to stay in the market. And so the question is, I suppose, partly, would such time varying incentives, which could be quite substantial because they would only be for a small amount of the time, would this have an effect in a temporary market disruption. Obviously, it's not going to stop the prices falling off a cliff, if that's what we're talking about, but it would stabilize an event potentially like the flash crash.
Professor Engel, I think that if you had a large enough incentive, that might work, but at the time, let's say like a flash crash time, you're facing enormous risks. So if you have an enormous edge, you are going to be more likely to participate, but it may have to be too big. I don't know. It may have to be a very big incentive.
And I would just add, look, nobody would expect any person in any vocation to catch falling knives, right? That's probably not good for your health. On the other hand, market making is part of what the market structure is, right? Hopefully, they're there making fair and efficient markets, and that facilitates people's interest and hopefully confidence in the marketplace. What we're talking about is a particular instance where stocks are falling precipitously. And again, I wouldn't subscribe or prescribe to the notion that market makers necessarily should step in and absorb, $500 billion worth of what would otherwise be market losses. It's impossible. On the other hand, that's why you have things like limit down or circuit breakers. At least getting to that point of hitting the circuit breaker or the limit down would be fair and orderly. Right? Walking away from it, as we saw clearly, does nothing. Nothing good comes out of that. So I do think that we're not talking about this particular market event for market makers standing up and taking one for the team. It really is more of an overall effort to ensure that all of these pieces are appropriately in place so we don't get an event like May 6th. Bad markets are going to happen. We had more than our share of bad markets over the past 2.5 years. What happened on May 6th was different, because not only do we have events a la Lehman or Barclays and what was happening in Greece, but we had a market that's evolved to a point where it's become so electronic and there's so little communication between the different exchanges that this is invariably going to happen. It wasn't right? You had a huge price point drop and it rebounded back. That clearly tells you that something is wrong systemically. It wasn't the event, it wasn't the shock to the system that caused a semi-permanent erosion in the value of stocks. And this is what we're talking about. We're trying to address the everyday life of investors and, as best we can, prepare for these events, making sure that we're not causing them by not paying attention to some of the details we need to pay attention to.
Most of the market makers that we spoke to after this event were, from an incentive perspective, I mean, they felt there was the right level of incentive per risk in the marketplace. That's why they were in there today. In most cases, as Michael pointed out, the trouble is, again, no regulation or no amount of obligation or anything else someone's not going to put their firm out of business over the course of the afternoon or 20 minutes. If I try and look at the positive of this, and not to state the obvious, but I will. This was really a remarkable event. 25% of the Russell 1000 securities dropped over 10% in about 90 seconds. And we were talking to the market makers, through the afternoon. And they were saying that their models were showing, they were anticipating a 5,000-point decline by the end of the day. They thought a bomb had gone off somewhere and that they were the last persons to hear about it. And they were, frankly, very concerned. So I think this is the point that Kevin's making, is that, when we look at circuit breakers, if we look at, market makers are there to help with the, orderly flow of traffic in the market, but they need orderly markets to operate in those situations. So thinking about circuit breakers, thinking about orderly restarts, how all that works, it gives them the confidence. The clearly erroneous trade rule, a really critical juncture. When they're doing trades in the market, they're hedging, right? No market maker wants to go into the overnight holding a long or a short position. Basically, they want to be neutral to the market. If they're not sure what the parameters are for a cancel, they're going to step away. Even if there's a bright, shiny line that says, okay, at 20%, if anything moves from here, we're going to stop markets and everything below that could be canceled. They'll still probably not be too incented to take trades up to that 20% line in the case that they're going to be lopsided, right, negatively biased in their hedge. So there are concerns there that raises other issues around, should it be straight cancels on clearly erroneous, or should we be rebooking at some other values similar to what the futures markets do? Again, this all comes around to, what do we facilitate to make the participants in the market be there through thick and thin, from a structural perspective rather than from a compensation perspective? Because if the structure's right, the business model's there for them to participate.
So I think your idea is very intriguing. and it's one that I'd certainly like to give it further thought as to the implications, because I will tell you that the retail investor, I already mentioned that we get about 10 to 15% of our orders overnight, right, because they go home. Well, the other time that the retail investor is in the market is when? During times of market duress. That's when they're at work and all of a sudden the coworker leans over and says, oh my gosh, see the market, it's down 600 points. Wow, my nest egg, my 401k, I better take a look at it, right? In fact, during that time, I think we got 127 orders in Accenture, down to 88 cents, which we ended up correcting. But the reality is that it's that 2%, 3% of the time that we really need to consider in the marketplace, that we need to put protections in. In 1987, we did have something that actually worked, and the market rebounded after that. The market halted, and it stopped. The fear was subsided, and actually the market started to, I believe, rebound after the second halt during that particular instance. It's been a while. But I think the combination of those incentives and some of the halts, the structures that we're bringing in, do go a long way to soothe confidence and fear.
So we've talked about market orders versus collared markets, stop-loss orders, pauses, rolling limits. And now we've spent a lot of time on market-making obligations, and we've also talked about the challenges of the reopen. I don't know. I've just listed what I thought, but I don't know where Joe's going to take us.
I wanted to pursue a question. You proposed of how do you incentivize greater depth of the market? You talked about taxes. Within the structure of the market, the rules, are there some that you think would do that better?
Honestly, I think that I think when Mary Shapiro and the Commission put forward the concept release on market structure, it's got a lot of noble thoughts in there, and I think on how to change market structure for the better. And again, I said this in our opening statement. I think that there's a lot of things that we can do to ultimately change that structure. One of those being how we incentivize the quote today. I really think that needs to be looked at. We've focused so much at the quote, but we've not focused anything on the size at all in the market.
I was just trying to ask you to be a little bit more specific on how you would answer that.
How I would get liquidity into the marketplace? Oh, okay, so what I said earlier, I think ways that you can start getting liquidity into the marketplace are through tax incentives, market data incentives, changing the structure of how you provide rebates to limit orders today, right? I think those are a couple important steps that you could take to do that. In today's markets, we tend to, it seems to be difficult to trade in the visible market because, and Kevin and these guys can know this a little bit better than my smaller retail orders, but the minute you expose your hand in the visible marketplace, the liquidity's gone. It evaporates, right? So if there are processes like that can help bring that liquidity into the visible marketplace, I think is important. And I'd specifically say some of the dark pool changes that we're looking at and how dark pools operate, I think are very important measures that we can take to help bring liquidity back into the markets. So again, I won't say there's a silver bullet solution to any of this. I think it's a much more comprehensive process that needs to be undertaken fundamentally with the entire market structure, which a lot of it, I think, is contained in the concept release.
Could I follow up on that just quickly and on Joe's question? And I don't want to suggest we're headed in this direction at all, but if, for example, and it's been proposed that orders have to have a minimum lifespan, but you could incentivize market makers not to continue to make markets by not having that rule apply to them. If we can think a little bit differently about not just the market structure as it is and what kind of incentives can we layer over it, but rather the market structure as we would like it to be and what kind of incentives might exist. So, one that pops into mind is, whether there would be limitations placed actually on the way trading is done today, and then some of those limitations might not apply to market makers as a way to incent them to be there in size.
So, and interestingly, again, I believe the CME has a process in place where they charge for cancellations, right, on a number of orders. Now, cancellations themselves, in our market structure today, we've got a profound amount of orders. If you take a look at any quote, be it Accenture or any stock, you see 70 to 90 quote updates in a single second. And a lot of these are almost like flickering quotations. Those are actually orders, followed by an immediate cancellation. The irony of that is that's taxing and utilizing the infrastructure of our nation's pipes to get that data out to the retail client. So yes, I do think there are things that can be done so that everyone has to pay their fair share to utilize the infrastructure of the bandwidth that we have. Our firm is one of the largest payers of market data in the industry, yet we don't use the largest pieces of the pipes. That seems a little unfair. So I think things like that, taxing cancellations on a certain basis, are ways that you can, and forcing people to, if you're going to put up a quote, right, maybe that quote does need to be there. That's the market data plan actually requires that the quote is visible for a certain
I'm going to turn to Maureen, but one of the things that this, I'm looking at this panel, not this panel, you know, I'm interested in is as trading velocity has increased, or one might say trading times have gone down into the microseconds and nanoseconds, and order size has come down. And the E-mini on that day, I think on most days, the average contract, average trade is 5 or 6 contracts, and that's about 300,000, 250 to 300,000 notional amount of stock. Market makers, and we've studied this, and you all get this data by early September, but we've studied this. I mean, they really are there. There's dozens and dozens of market makers in the E-mini, but they're staying relatively flat. I mean, their whole economic model, they're not putting a couple $2 billion on the line. I mean, they just simply aren't, and they're the average trade. So how, in an environment where average trade side has come just way down, average trade time, you know, has come down, all the orders, 70, 80 orders in Essentia in a second, and yet, as it was said earlier, in normal times, 99% of the time, the cost to transact in the futures and securities market has come way down. The bid-offer spreads have narrowed, and there's enormous benefit to the American investor in most times. But then what happens in these? So that's just a question. I'm just framing.
Can I just
Not that there's an answer, but Maureen has a question.
I just wanted to follow up on the idea of the incentivizing of size. And obviously one direct way to do it would be to change priority rules, to go from price time size to price size time. That would incentivize size, but yet at the same time your retail traders now would step behind size. So as we think about these priority rules, how do we sort through this? Are you in favor of a change in priority rules?
I think that's something that should be looked at. When you look at the retail investor, the beauty of dealing with a lot of market makers out there is they understand the importance of taking care of the investing public, right? So there are things that you can do in that particular instance. In fact, there's a lot of things that were done back in the early days where when New York traded a lot of the securities that had a very deep book, one of the ways that some of the other markets would incentivize orders on that they would match the liquidity available. So they kind of mark you where you're at in line on your limit order, so that when that order became available on New York, you were then executed for retail limit orders. And it was a way for the retail client to almost get double protection on their limit order. Again, if you incentivize a market maker, I think things like that could be created in the secondary market. I think that's a very intriguing idea to bring size back to the marketplace.
Can I suggest that the bigger problem is that institutions have no incentive to post real liquidity in these markets? Nothing could be clearer than to watch IBM trade down in a vacuum and some of the other big cap names that ordinarily would have had significant levels of interest on that book. But because of the predatory nature of some of the participants today, we have no incentive to post large amounts of liquidity. I submit to you, transaction costs have come down. But could they be lower if the markets were more efficient? Are there dimensions of cost that we can't understand today because we're not even sure what the value of a quote is? There's 40 places where stocks are transacted at any given point in time. None of us have clarity on what the real supply and demand is in most issues, right? These are fundamental issues of what the value of a securities market is. So I submit that a more important effort would be to try to help institutions come to a better understanding of how we're incentivized to send more of our orders directly to the market and to post them so people can see them. Priority is an important point. A lot of people are now talking about whether or not there should be a trade-at rule. A trade-at rule would say not only is there a top-of-book protection, but the first one in gets executed. Well, that's reasonable. Some others would say, don't just do one top or one part of the book, do the whole book. Why shouldn't there be time and price priority at each level, not just at the quoted level? I'm not prepared to go there just yet, but I do believe we have that in our arsenal ultimately if we're not finding the right mix. But make no mistake about it. If institutions had higher incentives to post limit orders, if there weren't these nefarious participants jump in front of us, they had no interest in a stock until we had an interest. We show it, they jump in front of us. We hide in dark pools now. That's how we accomplish our orders. We worry about their infiltration in dark pools. It's not 70 quotes a second, Chris. It's 5,000 quotes in a second in some of these names. This is the new phenomenon called quote stuffing, right? And so what happens is they send, in a particular issue, 5,000 quotes within a second. What in the world is the value of that enterprise? So let's concentrate on some of these things and really kind of get back more to the fundamentals, which is really creating a market where transparency and posting liquidity is not only incentivized, but creates efficiency and effectiveness for all participants.
I just want to make sure, and there's one issue that we would need to get to still is ETFs, but all right, just Joe.
Yeah, well, just following up on this a little bit, the one time where these issues become very relevant is if you had rules about the rate of decline of stocks. Then the question of who gets, you have clearly a statement of an excess demand or supply that's being manifested, and you're restricting the market. At that point, who gets access, who gets the priority of fulfillment makes a big deal. And one might argue that that's going back to Rob's point about having it sensitive to the time. This is an automatic way where the greater the market imbalance, the greater the value of the prioritization. Or prioritization rule would then have, in a way, an automatic way of giving more return to people who are putting in greater depth.
Can I make a comment about that? Is that we don't, these things that we're talking about right now seem to be more about how the market functions day in, day out all the time, not so much about the flash crash or something like that, although there's clearly a relation. How market making activity is done is going to affect crashes or flash crashes. And we don't even know, I don't think in this case, whether the flash crash was an alternative that day to a real crash. It was a bad day. We don't know. We shouldn't confuse these things. When we talk about things like Invesco not having incentive to post size, I think that's true. But as you've also said, the transaction costs are much lower because trading's a little bit like a repeated game where you have to adjust. You have to adjust to what other participants are doing. Other participants are showing smaller size and trading in smaller lots more frequently. Other participants have to adjust. If you don't adjust, you're disadvantaged. Okay, and so the market is adjusted by offering dark pools, but there's only so far it can go. Other participants have to adjust and change their trading size. If they don't want to trade their trading size, they will in fact be disadvantaged. But it's not clear at all that that has a lot to do with the flash crash.
I totally disagree. Liquidity is the issue in the flash crash. If people had been there and had more incentive to be there, and by the way, we came rushing in to buy a number of securities that were dislocated, right? So we would have been there, others would have been there. So I think it's exactly related to what happened here. Confidence in the markets is everything, whether it's on the institutional side or individual side, whether it's the issuers or participants who are just watching who have interest in 401ks or whatever. It's everything. And until and unless we get greater levels of confidence in the market and better ability for all participants to make sure that it's a level and fair playing field, we are going to have these kinds of problems.
David.
As I listen to this, I agree. We're not really addressing the flash crash problems, which exist in my mind because of some problems that have existed in the high-frequency trading market. We have basically computer trading going on with the retail investors severely disadvantaged by the others who are able to trade in an automated way. We have programs which are established and are not subject to human intervention, so that we're talking about how to deal with a whole series of traders who are programming their computers to trade based upon events that they can imagine. And if they don't imagine a really serious loss of liquidity in a way that is realistic, we're not going to get we're going to continue to have these kinds of events. I just don't know what it is we can do to avoid this kind of a computer-generated loss of confidence.
Well, I think we have to understand first what actually did happen, and I'm not sure we really do understand that. I know you're all working on that, but there's a few things that we may have to look at. Like, there's also the other side of the equation, the liquidity demanders. I think there's been much less focus on that. I think we have a reasonable understanding what happened with the liquidity providers, that they more or less went away eventually. And we have some reason to understand why they did, because their market data appeared to be corrupted, although it's not, it may have been correct prints that looked bad, but things went off the rails from there. But there was no connection between the information that the liquidity provider has, whether it's a person or whether it's an electronic system, that says, okay, this is scary, and at the same time a liquidity demander, whether it's a TD client or an institutional client who's sending orders, who isn't really in touch with what a market maker's thinking at that point, and you have this disconnect between what the liquidity providers are thinking. All of a sudden they're saying, I got to go away, and the liquidity demanders are they just keep going on their merry way sending orders. That's where the imbalance is. It takes two sides to have an imbalance. And we haven't focused a lot on the other side of the equation, and maybe we ought to. To respond to your point about what the computers are doing in disadvantaging retail, retail has been a very significant winner in this whole thing because their trading costs are lower by far, their commissions are lower, and I'm sure that TD's data would bear that out. On the machines not being like unguided, they're not. There's people sitting in front of those machines, and those are the ones who turned them off. So there are people sitting there, just like in the old world of market makers, there were people there to not pick up the phone, which is what happened.
Yeah, I want to be, I guess, cautious. I'm a little bit in between these two groups as far as wanting to be sure we don't throw out the good with the bad. I would agree that we have seen, if I use something like the exchange-traded fund, where it's a little bit, it's difficult to say, are you getting the right price for IBM or even for Accenture, right? We have a range, but again, it's trading in a lot of different places. We can look at the ETF, at the underlying securities in that ETF, the cost of acquiring that basket for a large institution, and for the largest, heaviest traded ETFs, the cost of the spread, acquiring that in the market for the average investor, is inside of that basket because of the activity of all the trading that's going on in the market. So for many days out of the year, many hours out of the year, I would say that there is a benefit there. But I'll go back to this whole interlinked situation. How you define a high-frequency trader, I haven't heard anyone that's come up with any one solution. I don't know much about quote stuffing intuitively. That doesn't sound like a good thing, but I'll admit I don't know what I don't know in that situation. But I do think we have to be cognizant that even long-term investors at some point do want to sell their securities, and you're not going to naturally find another long-term investor to sell it to all the time. There's a benefit to this trading that's going on in the marketplace. What we have to be aware of is what are the behaviors, I guess, that we want to link here. If co-location of server farms with the data source is important in today's model, then maybe that's a privilege that you do give to a lead market maker, not someone else that's just going to throw trades in front of the lead market makers. And for doing that co-location, maybe you have to say there's 3 levels of orders with size underneath, because anyone can come up 97% of the time and throw out a best bid and offer and only show 100 shares. That's the way I think we have to be thinking about the behavior in the marketplace, is to try and negate 20 bad minutes.
Can I, just because you mentioned ETF, and just shift for a moment, because I think between at least these two firms, I know you're not over there, but and one other firm, it's probably 80% of the ETF providers. You said something in your opening remarks that I don't think bears out with some of the facts that we've been looking at. You said that ETFs sort of followed. You used different words, but that was it. In fact, I thought that at the critical minutes, not just dozens, but it got to the point of hundreds of ETFs really were breaking down early. And they weren't just small ones. One of them was one of the largest Vanguard ones. I can't remember the name of it. But so what do you think it was? Why, really 5, 6, 7 minutes before the dive, there were so many ETFs that were significantly down and more than the market?
Yeah, well, I guess I would like to see that data, because I would not agree with that statement. From what we've looked at from time and quotes of the individual securities of the underlying baskets and where the ETFs were. No, it's a very different question. I get why you're saying something different. I'm not saying whether the ETFs reflected the time, but there was a lot of ETFs in the 5, 6, 7 minutes before the dive that were already significantly down, and a high percentage that hit this busted trade rule, the 60% rule, and so forth. So what is it in ETF land that you think has a higher proportion of busted trades, that there was a group of them, not the broad market ones, but more of them that were in the 5 to 10 minutes early? Yeah. Again, I would still assert that I did not see, and I'd be happy to look at any data that you have that would show that ETFs were leading the charge on this. The problem with pricing, every ETF, for those of you that might not be familiar with it, an exchange-traded fund generally follows the market value, follows the value of the underlying securities. The pricing that's put out by the market makers is determined by calculating the weighted value of the securities that make up that ETF. As it became more difficult to come to that value, as these individual securities were rapidly dropping, you can almost think of it as a contagion in the basket. As bad prints were going off in multiple different locations showing pricing all over the boards, the confidence level in the price, the derived price of the ETF, was very unclear, and the confidence level was falling rapidly, and that's where you started to see the step back from the pricing. The closer the ETF got, and the securities that make up the ETF got to that 10% threshold, that's the point in some situations where you saw a really rapid acceleration of the disconnect between the price of the ETF and the individual securities, where in some cases there might have been a leveling off and a continued descent of the ETF until the pullback several minutes later. A number of reasons for that. Again, one of it is understanding how they calculate the price, and it's the price of the ETF based on the underlying security. You also have the situation that some of these people that we've talked about, some of the electronic market makers, are not calculating the price of the underlying securities. They're looking at what the lead market maker is doing in the market. As those market makers were unable to calculate a price and stepped away, then the opportunistic traders, or the people that are in there sort of at top of book, also went away. You raised the point of ETFs being a disproportionate number of the cancels. As I mentioned in my statement, ETFs make up about 30% of the trades on any given day. They were about 60% of the cancels. The reason that we see for that, and I've seen some data recently come out, I think, from the ICI that also supports this, from time and quote data that came from the New York Stock Exchange, what we saw was once the self-help provisions kicked in, over 90% of the exchange-traded funds in the U.S., their primary listing is on New York Stock Exchange ARCA platform. And about 30 to 40% of the trades usually execute there, I think is a ballpark number each day. For the lower average daily volume ETFs, it's over 60% of the daily executions occur on NYSE ARCA. So at the most critical juncture of the day, or of that 20 minutes, when liquidity was most important, where most of the trades would go off towards NYSE ARCA, some of that basically got lost in the closed loop. where again there was more sellers than buyers. Basically, as the people normally making quotes in these went away, you had that, and so that's in our view why you saw a disproportionate amount of ETF cancels versus individual securities.
Rick, help me out here.
Sure. Well, no, I think I agree with your questions. I thought from exactly the direction you said with respect to self-help. Certainly any time the primary market in any listed security goes out, there's a tendency for that to be the deepest book, and that I have no doubt I would expect, waiting for the analysis of the SEC and CFTC, that's one reason why ETFs were a substantial percentage of the cancels. A couple of you suggested there should be changes in reviews from the standpoint of self-help. Self-help today is essentially driven by SEC fairly specific standards from the standpoint of what an exchange or a firm must see with respect to response time on their orders before calling self-help. It sounds like you think that some of the calls were too quick or something else should happen. I guess my question would be, how would you change the self-help requirements, or would you look at self-help with respect to a primary market as perhaps another reason to have a brief pause or something else? Agree that self-help didn't work terribly well that day. What would be the change that would make sense?
Gary, can I just add on to Rick's question, which
Please.
is, and do you think it's beneficial to have something like LRPs in existence on one major exchange but not the others? So do you think, not to steal your whole question, Rick, but
I think you've added an additional question. It's throwing it off.
No, there's a semicolon in between. It's still the same question. Is it beneficial to have different rules, or should they be common? I mean, if you guys could rewrite the rules.
Self-helps and LRPs, but we don't have 2 hours.
So I'll say a couple of things. Just one point that I wanted to make on ETFs, and I'll go really quick here. The one point, kind of one theory that I have, certainly exchange-traded funds are very, very important to retail investors and advisors. We see quite a bit of that business at the firm. I'll just submit to you that the IPOV calculations for those aren't always readily disseminated to the entire marketplace.
Would say what that is, just for the
so
public.
My
what does that stand for? IPOV?
Yeah, my feeble understanding of this would be the price value, actually the mechanism that allows you to calculate what the value of the ETF itself is.
That's good enough, I think, for now.
So
that's not transparent.
That's not transparent. It's not readily disseminated in the price feed, or it's not readily disseminated by the underwriter of the specific ETF. We saw that in one of our products. So I'd say that probably is partially responsible for it. Now, getting to the issue of clearly erroneous, I think similar to the circuit breakers that we just installed, the self-help rules have an itchy trigger finger available to them, right? So there's no clear-cut guidelines when that was implemented during Reg MS on exactly when or how you should implement the self-help rules. It's not standardized, I'd say, across the exchanges. It's not consistent. And I think that's the exact same issue with the LRPs. LRPs are not on every exchange, and that created on May 6th, that created a real dichotomy in trading in that, was that a real price? Was it a self-help? There were some self-help rules that were called against the NYSE at that particular time. I think in order to fix that, the rules across the exchanges need to be absolutely consistent. And that's one thing that we don't have, not even with the circuit breaker rules today that we just installed. They're not consistent across the exchanges, hence why we've seen issues with Genzyme and Citigroup and Hewlett-Packard as of late. I think that's the most important thing that could happen with a self-help change.
Yeah. From a competitive markets perspective, I mean, I think you want to have self-help provisions. You want to have something that's there that says if there's a problem at exchange A, the whole system doesn't grind to a halt. But I think that has to be in conjunction with if there's security-specific issues, that approach then is uniform across the exchanges, that you don't have a situation, again, where you're turning it off in one place, having it flow at another, where there might be loss of liquidity. Just to clarify, something that Chris said, the IIVs or IOPVs, that go by a different name, again, indicative values, this is a calculation of the underlying securities of the ETFs. It's usually calculated by the exchange or by a third party, and it has a ticker assigned to it, and you can pull it up and look at it. It is, again, just an indicative value. We've seen plenty of times where the value of the ETF is really the price discovery mechanism because the ways that the IIVs are calculated are different. If you think about a domestic equity ETF versus an international ETF, IIV calcs a little bit more clean during market hours of the domestic equity that's trading. For an international security where the underlying securities are not trading and you have to do currency overlays to get to the value of an IIV, not as clean linkage. So just want to be clear on sort of the benefits, pros and cons of the IIV as a mechanism. It's something that's there as a reference point. It is not used by market makers as a means of getting to a price of an ETF.
Others on self-help and LRPs.
Yeah, so can I just add on self-help? Remember, Rick, and you were involved very heavily in these discussions. The whole notion at some level with NMS was to really facilitate competition amongst marketplaces. New York, at that time, New York Stock Exchange had a 65-70% market share. And many of us were concerned that our orders had to be subjected to the continuous auction market process, which we didn't want. Sending orders to the exchange were really indications of interest. They really weren't executable orders, right? So we wanted that to change. And part of that was that you create this self-help mechanism that would encourage or perhaps discourage particular, certain manual exchanges from trying to always have this mechanism where they would sort of try to commandeer all the order flow. So self-help was a way that you could avoid a market who was trying to get their own market share up by always being in slow mode. There is an inherent conflict of interest between the exchanges and self-help. If you ignore one market, presumably you get more market share, right? And markets, now all exchanges basically are for-profit enterprises, and that's a big difference from when this rule was put together and some of the tenets behind it were formulated. I do think, Jack, to your question, that LRPs are a reasonable pursuit. I don't think that they necessarily should be pushed on all markets, but I do think if we've learned anything in this enterprise, it's that taking time and making sure we understand exactly what's going, whether that's in seconds or minutes, certainly could be debated, isn't a bad thing, right? So if we could get to a market that amongst all the exchanges supported this ability to sort of take inventory of things after you get down to a certain price dislocation, I think that would be a very workable and efficient thing for the markets.
And I'd add on the self-help, I'd be interested, or we'd be interested in seeing, just something as simple as if you're going to declare it, to go back to, what are the reasons for it? Do you have to go back to your regulatory body and say, we filed a self-help, this is why, this is the proof point behind it, end of story, so that there's a clear trail as to why it was called, and, was it for a good cause?
There are hundreds a day, so I don't think the regular, I don't want to speak for the SEC, but I don't think.
Let me try to speak slightly for the SEC. There is a record-keeping requirement and a justification requirement with respect to track self-help. And I think actually there is some fairly specific standards with respect to the delays in return of orders before an exchange or a market can do self-help.
Right. And
that's what we look at
on the self-help, I think there was a provision, as I understand it, that if it's longer than a second that you don't have connectivity, or you can judge what connectivity is, then they can go into self-help. Jack? Jack and Rob, we're sort of running a little late, so I want to try to get
I want to just ask about a specific, you keep trying to get them back to ETFs and it gets hijacked away, so I want to go back, just ask Noel a specific question. He had a definitive recommendation on circuit breakers and the treatment of ETFs in a circuit breaker mode. Pam recommended an expansion of circuit breakers, but what did you mean by having circuit breakers be the same for ETFs as for stocks? If I captured it right. Did I get that right?
Our view was just we were concerned, early on when the pilot first rolled out around the thought of having stocks in a circuit breaker mode and not the individual, and not the ETFs that might have those in the basket. Just because if there was a system-wide error, or a systemic issue, I should say, something that was larger. On any given day, one or two stocks might stop trading during the day for a variety of reasons. And this goes back to what I was saying earlier, that market makers are calculating the value of the ETF based on those underlying securities. And if one or two stocks stop trading and it's for a known reason, news just came out that can quantify it, they can get their heads around it, that's not going to disrupt their ability to price the basket or their confidence in that pricing level. But if it's a lot of stocks are going and then they all stop, but the ETF is still trading, you're basically at, you're in price discovery mode. Maybe that works for the short term, but for the long term, it feels like there should be a synchronization between what's happening and stopping the ETFs versus the underlying securities.
Can I just press that to make sure I understand the point? So obviously, as the pilot moves to a second phase, a large number of ETFs will be pulled into it. Are you saying beyond being subject to the pause as that pilot gets expanded, you also think an ETF should stop if a certain percentage of the stocks in the ETF have paused, or
no?
What would be your thinking?
Yeah, I think that would be extremely difficult to put together. I think it just more came down to we wouldn't want broad swaths of the individual securities stop trading and the ETFs aren't there. So I think the ETF still has to be plugged to its value, where it started the day or whatever intraday view that we're looking at, but that there should be the safety net beneath the ETF, just like there is beneath the individual securities that make it up.
One thing, Jack and Rick and this group here, that I think that the SEC and we're going to be looking for is your thoughts also is if there's the broad market circuit breakers, which we know we're going to get advice from you, right? In a timely way. Trust. All right, we'll get that on the broad market, which currently is these 10 and 20% markets. The ETF land starts to blur into that, because if you put in 5-minute pauses on ETFs, for instance, if the SPDR 500 went into the 5-minute pause, what does that mean for the overall market? What does it mean to the E-mini? So it's sort of a continuum from individual stocks to small basket ETFs to broad market ETFs to the overall market. So I raised that as a question for this panel that I think we're all going to want to get your advice
on. One of the things that many of you brought up today we haven't actually discussed at all, and perhaps that's just as well, but this question of what are the rules for breaking trades. And it seems that we talked about collars as ways of pre-trade breaking trades before they get entered, but the difference between breaking trades afterwards is that you know more by the time you're deciding whether to break a trade than you do ex ante at the moment when the trade is being entered. Do you really think that rules should be set up so that you would know ex ante whether a trade was going to be broken? And if so, maybe this is just the same as the collars that we're talking about.
Yes, absolutely. One of the major issues of May 6th was that no one knew into the wee hours of the night exactly what the percentage was going to be, and there was a lot of discussion. In fact,
the joint report regarding the, quote, arbitrary, almost decision whereby the 60% was reached. I believe that any rules, which I think clearly erroneous, is a very good idea. It's one of the unique things, I think, that we have in our capital market structure that some of the other structures around the world don't necessarily have. And I think it's worked well. It's never an enjoyable process for either party at all. But in the particular case, the rules need to be clear, concise, and expeditious so that we're not at 8 o'clock at night on May 6th saying, okay, 60% away, those trades are going to be busted, and then going and finding those trades. I think it's got to be a much more clear process and coordinated across the exchanges, and it wasn't at all.
Pam, did you have anything? Just follow up quick on that. Did I hear you right in your initial statement that you're satisfied with the new proposed rules of the exchanges in FINRA with respect to this type of event? Or
I would say yes, that it starts to go down the road of consistency, coupled with the stock by stock halts. Yes.
Pam, did you have a view on that? Because
I do. I agree, and I support what you're doing in that area, because that was very disheartening for us as well. I mean, at the end of the day, we didn't know what the heck was going on. And, I mean, that's obviously just not good at all to have that kind of disruption.
I just want to add, I think those rules, they're important. I think they need to be communicated. We heard from one investor that probably had a stock drop about 45%. It wasn't broken. And he actually called us up about a week after May 6th wanting to know what he could do. And I think it needs to be clear to the investors, these are the rules that will cause a trade to be broken so they know going in what to expect. But I think it needs to be combined with other measures to prevent illiquid trading, which might cause an artificial large price swing as well. So I don't think you can have one without the other. I think there needs to be clarity for all individual investors going to the trade.
We still need to hear from staff on the subcommittee reports. I just want to make sure that if there are more subjects, or Joe. Yeah.
I wanted to pursue the question about restarting that was raised. And the question, I guess, two questions. One is, what are the consequences of you said it was upsetting that it wasn't done in an orderly way, but who loses and how significant is this? I mean, obviously, it'd be better if it weren't, but is this a very significant thing? And suggestions about how it might be done.
This is the reopening after there's a 5-minute pause or any such circuit breaker pause.
So I will submit that I believe that the opening processes are some of the most difficult processes in our market structure today. When you've got a multitude of different market centers, that's something that's very uncoordinated. For example, in the listed markets, we've got 2 different openings. NASDAQ's got a listed opening. New York's got a different listed opening. Those occur at very different prices, very confusing for investors. At the same time, adding more opening processes into that, when we can't open at 9:30 in the morning in this day and age, when we're trading in milliseconds, I think is something that seriously needs to be looked at and considered. And that's why it gives me great concern when we're halting stocks and then starting a reopening process, because you get a lot of confusion out of it. And with the issues that we've had of the halted stocks and the new program, almost every one of those have literally been attributed to how the stock reopened again once it was closed. Hewlett-Packard Genzyme, for example.
And yet there is a trade-off, right? So no one's here to suggest that this process would be easy, but what's the consequence in not doing it? And I think we've seen some evidence of what the consequence is. And I submit that that's worse than what could be the preventative maintenance to prevent it from happening again.
What happens when you place an order? How do you get and there are these different prices in the beginning. Obviously,
it's not an easy process, I tell you that much. We try to educate our clients a lot about the differences in the various openings across the various markets. And in this day and age, even the options exchanges, we've got 8 options exchanges now with 8 different opening prices that go off. It tends to be very difficult. We try to use technology quite a bit. So if one exchange happens to open before another one, we try to pull those orders back and send them to the other exchange. There's no easy process. It makes it difficult to a big degree. It's the subject of a lot of client complaints on a daily basis from not understanding the differences in the market openings that exist. And I think for issuers as well, too, seeing different opening prices and how those print in the paper each day tends to be very confusing. So.
Now, the pause itself operates differently, right? The pause itself requires a trade, other than very exceptional circumstances when the market's having technology problems, essentially requires a trade from the listing market before anybody else trades. Are you troubled by that, or do you think that basically makes sense?
No, actually, I think that makes sense, but I think it's still a little confusing. And don't get me wrong, Kevin brought up a really good point, which is what's the alternative, right? And the alternative looks, if we were not to have that, looks worse. So I again, with stock-by-stock halts, I think that I would not like to see that as the ultimate end solution to where we're at. Earlier in this conversation, we were talking about trading bans and limits up and limits down. I think the CME's run a very good program for 20-plus years with that, and I think that's something that this advisory committee should look at, maybe changing the stock-by-stock halts to something more like that.
And Rick, as you know, there are indications that investors get when these things are about to reopen. It's not like they happen in a vacuum, and you have no idea what the indication is. Now, from an institutional perspective, that's probably much easier to source than the retail investor, and if that's more problematic than I understand it to be, probably needs to be addressed.
Other topics? I want to thank you all, but I'm going to bring it back to Pam's and it could have been a story of an investor, but to me the most riveting testimony, with all respect. But it reminds me, I mean, we're fortunate to have Commissioner Dunn with us today, but 14 days ago, he's on a highway, and not anything to his fault. I feel the same way about this Essentia. Just a car comes out, and it's a massive pileup. And fortunately, he's here, and he's healthy. He's, a little more than a little bruised and battered. And I feel about, thank God Mike's here, and thank God Essentia stock got back to the right levels. But the same way, for 10 seconds, a split moment, somebody sped through a stop sign is what happened to Mike, And for some 10 seconds, 10,000 shares, that's nothing. Took your stock from 38 to a penny. So we can't have that. And so that's the direction that I'm kind of giving probably for my co-chair to the advisory committee. To me, that was the most riveting. And it could have been a personal investor as well. Something doesn't feel right that 10 seconds, 10,000 shares takes you from $38. And your market cap at 38 was how many billion?
Less than 29 billion, but not a lot. I mean, it's roughly 40 now.
Yeah.
So
consequential, 25 to 30 billion of market capitalization, at least on paper, in 10 seconds was less than stunning, less than 10 million. Obviously, that wasn't true reflection of supply and demand and the valuation that investors placed on the long-term prospects of your company. So that's what we're looking for, good advice for.
The analogy brings it home very painfully.
Yeah. Well, thankfully both of you are here, but he's got his. So I want to thank each of you because this has just been tremendous. And if there's not any further questions, no. So then we will, I think, just take a few moments before we hear from staff. We need to hear from staff. We have 2 subcommittees that we set up, so officially they need to report. Just to, we could do it if we had chairs of the subcommittee, which I'm still encouraging. If you all want to place, pick chairs of these 2 subcommittees, then you could report. But we need to, for the public, have some staff come and report on this subcommittee thing. So if you all, we're going to take 2 minutes. If you all, we're going to thank our panelists. And then I can't remember who from the staff is going to sit down here and just give us the quick review. I'm going to try to bring this back together. I thank you all. I hope if I gave a long enough break. Again, I want to thank the panelists because that was very, very helpful discussion. I can just tell from the 10-minute break that that to be the case. The next item on our agenda is an update from our two subcommittees. As we had mentioned at our last meeting, we believe that it's important to provide the public with as much transparency about what these subcommittees are doing, their goals, priorities, deliberations. As a result, we'll have reports from these subcommittees as a standing item on our committee agendas. As I mentioned, if the two committees, I know you've only met a couple times, but if the two committees actually appoint committee chairs amongst yourselves, then you all. So I know you all are thinking about in your busy schedules who wants to be a committee chair, but then you get to report. But in the meantime, but that would be helpful. But in the meantime, we're asking staff to report. The first subcommittee is the Cross-Market Linkages Subcommittee, which focuses on topics related to the futures markets. This subcommittee addresses topics including the analysis of orders and trading and the broad-based E-mini 500 contract, liquidity, and the selling pressure that we've seen in May 6, trading practice and rules that can affect both futures and equities markets and some of the cross-market mechanisms and arbitrage. That subcommittee is Brooksley Bourne, Jack Brennan, David Reuter, Joe Stiglitz. You know, Brooksley's not here. We can make her chair. But you think
David wasn't here either.
I see by a vote of 3 and 1 abstention. No. All right, you all can. Jim Moser from the CFTC will provide an update on this subcommittee. I'm going to introduce the second one too, and then Jim, I'll hand it over to you. But the second subcommittee is Pre-Trade Risk Management Subcommittee, and focuses on topics related to equities, ETFs, and equity index options, though I would note pre-trade risk management also happens in the futures markets. I know you're talking about that too. The subcommittee will provide an analysis of the liquidity and selling pressures on May 6th, provide in-depth look at the order and trading of select dislocated securities, and the trade practices and rules around that, implications May 6th. Additionally, the subcommittee will provide a review of the latency issues. That's how long things get to the consolidated tape. Members of the pre-trade group, or the other 4 members, Rob Engel, Rick Ketchum, Maureen, and Susan. I guess I know who the 3 of you are appointing as chair, but no, that's not fair to Susan. She'll be great. I thought I had that Robert, but Greg's going to do it.
Susan, I'm on.
All right, Susan is all right. Protecting.
She'd still be great.
Susan, I apologize because we should have allowed you time to ask questions, and I didn't give you that chance on the earlier panels. So, but I see that you're speaking up to make sure that you're represented, not to be chair.
Right.
But Greg Berman is going to work and report for us for the SEC. So, Jim and Greg, take it away.
Good morning, Chair Shapiro and Gensler and the advisory group. I'll be summarizing the cross-market presentations that were given by staff at the 2 conference calls that were held since the last public meeting. First, on the 6th of July call, there were 2 presentations made. First was an analysis of the E-mini S&P 500 futures, the E-mini trading volume, and then there was an analysis of the E-mini order book. On the analysis of the E-mini trading volume and price, we found that trading activity exceeded 50,000 contracts per minute at 2 points on May 6th, at the point when prices declined precipitously, and then about an hour later or 10 minutes before the close. Trading activity was classified into 2 groups. The first group paired aggressive selling to passive buying. The second group paired aggressive buying to passive selling. Comparing these to price changes, we found no clear pattern emerging. However, at the price trough, passive buy volume much exceeded aggressive buy volume. In a plot of differences between aggressive buy and sell activity, aggressive selling turned out to be more prevalent than aggressive buying, with that difference increasing throughout the afternoon and then reaching a minimum at the time of the sharp price decline. A rebound in the aggressive buy-sell difference also coincided with the price rebound. As for the analysis of the E-mini order book, using CME-supplied Globex message data, staff reconstructed the limit order book for the E-mini futures contract on the 6th of May, plotting the near inside order book depth. This would be the best 5 bids and best 5 offers. The order book appears to have been well balanced, with a number of buy orders generally close to the number of sell orders. At about 2:30 Eastern Time, there was a sharp drop-off on both sides of the near inside order book, with the drop-off in orders to buy slightly leading, then matching orders to sell. Just prior to about 3 p.m., orders to sell spiked, followed by a recovery period as the order book filled in, approaching its previous levels. Didn't quite get there, but approaching those. These data closely matched the Globex data that was provided by the CME and plotted in the May 16th preliminary report. So we felt that we had closely replicated the process that the CME was using. Staff then used the reconstructed Globex order book to construct an analysis of all standing bids and offers. The pattern from that analysis differs in that the depth of the order book can be seen to have been declining throughout the day. Staff noticed stale sell orders can be expected to accumulate over a period of declining prices. So we're not entirely comfortable with analyzing that portion of the order book, but we can say that the buy side of the order book was declining throughout the day. Staff has recently obtained order book data for some other days, as was recommended by the advisory group. These are being used to compare the May 6th order book analysis to that of other days, both critical days and so-called normal days. If I may go on. Okay. On the 29th of July, we had a second call. One presentation was made in that case, trader classification and trader behavior in the June 2010 E-mini futures contract. In this case, the data were grouped into a pre-event period that would be May 3rd, 4th, and 5th, and then an event data group on May 6th. Trading activity patterns observed during the pre-event period are analyzed in order to classify accounts as one of the following: market makers, high-frequency traders, buy, seller, opportunistic trader, and noise trader. Comparing the pre-event period to May 6th on the basis of both percentage of volume and percentage of trades, activity levels were similar for those of the assigned categories. The largest differences are for the seller and the opportunistic seller categories. Seller activity as a percentage of trades increased from 10.10% in the pre-event period, decreased from 10.10% in the pre-event period to 6.95% in the event period. Opportunistic trader activity increased from 33.34% in the pre-event period to 40.13% in the event period. We also noted that the noise trader activity, albeit small in both periods, did drop by half and went from 2.2% of trades in the pre-event period to 1.04% during the event period. The next step of this analysis will apply the relationship of trader categories to volatility normalized price changes determined in the pre-event period and apply those into the event period. This will obtain some estimates of predicted price impacts from changes in the trading activity of any single group. That's all I have. But let me wind this up by thanking the advisory group for their insights and guidances. It's been an interesting summer. It reminds me of when I was a university professor and we used to do all of our research in the summer. So it's been fun.
Yeah. And I think that the actual, if I recall, I mean, they may not be yet on our website for the public. I think these documents, whatever Jim just went through, will be on our website related to this committee. But questions from the full committee, either to Jim or to other members of the committee who are on the subcommittee? And I just want to make sure, because last time I didn't. Susan, did you have any questions on this one?
No, I'm fine. Thank you very much.
Greg?
Thank you, Chairman. Since the latest full meeting of the Joint Advisory Committee on June 22nd, we've held 2 conference calls with members of the Pre-Trade Risk Management Subcommittee. As you know, our investigation into the events of May 6th is based on a 2-pronged approach, combining objective data analysis with direct insights from market participants concerning their actions and decisions on the afternoon of May 6th. In our first subcommittee call, held on July 7th, we discussed preliminary observations of our interviews to date with market participants. At that time, we had already held a series of extensive interviews with market makers in equities and exchange-traded funds, from which an emerging theme had developed. We reported that most of the firms we interviewed significantly curtailed or completely halted their market-making activities during and immediately after the rapid downturn in prices at or around 2:40 of the afternoon of May 6th. Many market-making firms use a combination of automated algorithms and human traders to oversee their operations. As such, data integrity was cited by the firms as their #1 concern. To protect against trading on erroneous data, every market maker implements automated stops that trigger when any questionable data is received. One way of identifying potential bad data is to look for large, rapid price moves, which were unfortunately in significant abundance on May 6th. For example, the rapid decline in prices of the E-mini contract at around 240 triggered data integrity pauses in trading across a number of automated market-making algorithms, even though these price declines were, of course, accurate. Rapid declines in individual securities also contributed to data integrity concerns and triggered likewise pauses. Some market makers also reported that trading volume overwhelmed their internal systems, causing latencies in their ability to monitor the markets and confirm orders. Others found delays in the market feeds themselves and questioned their own ability to track prices accurately and in real time. Many were concerned that trades were going to be broken and that they would be inadvertently left long or short one side of the market. It is fair to say that most market participants felt a certain sense of real-time confusion as to what was actually occurring as many securities began to dislocate. We further noted that since exchange-traded funds are based on baskets of securities, any data issues, whether real or perceived, with the pricing of an individual security can trigger data integrity pauses in the trading of ETFs that hold those securities, and hence there is a knock-on effect. This is one of the reasons ETFs may have been disproportionately affected on May 6th. The automated trading system paused as automated trading systems paused, some market makers withdrew completely from the markets and relied on auto-generated stub quotes to fulfill their market maker obligations. Others fell back to manual trading but had to limit their focus to only a subset of securities and were not able to keep up with the unprecedented volumes that were ever more concentrated as yet other market makers continued to withdraw. Through our interview process, we were actually able to trace back a significant number of trades that were executed at stub quotes and were subsequently deemed erroneous and broken by the exchanges later that evening. Our interviews with market makers were only a first step in a planned series of extensive interviews and conversations with a wide variety of market participants. At this time, we are pleased to report that in addition to equity and ETF market makers, we have now completed many dozens of detailed interviews with option market makers, internalizers, dark pools, high-frequency traders, and cross-market arbitrageurs. The noted behavior of almost all market participants remains consistent with the general theme of a rapid withdrawal of liquidity, but the specifics for each participant differ materially based on the type of participant. A detailed summary of these findings will be presented in our upcoming September report. In our second subcommittee call, held on July 29th, we covered 3 individual but related topics. These topics were chosen because they are both complicated and subtle in nature, have lots of technicalities that afforded lots of questions, and not necessarily because we believe that they necessarily presented any problems on May 6th. A number of those topics were actually discussed today, and as demonstrated, there are lots of opinions on these different topics. We began with our Division of Investment Management giving a detailed presentation about the ETF market itself. Exchange-traded funds are a specific type of exchange-traded product registered under the Investment Company Act of 1940. Today, ETFs represent about $700 billion in assets. Like mutual funds, ETFs hold a portfolio of securities and are often designed to track a given index or sector. However, unlike mutual funds, ETFs are not individually redeemable at a net asset value, but instead are traded in the secondary market alongside of individual equities. Only authorized participants can directly engage in transactions with the ETF to create or redeem large blocks of ETFs known as creation units. These transactions are executed at the end of the trading day through an exchange of creation units for a predefined basket of securities or their cash equivalents. In this fashion, the prices of ETFs and the prices of the securities that underlie the ETFs are linked through a detailed arbitrage relationship. Understanding how these relationships function provides the context to and some color on the behavior of ETF market participants on May 6th. We then turn to a presentation given by the New York Stock Exchange on the use of liquidity replenishment points, or LRPs. LRPs are essentially represent price bands within which an individual security can trade in an automated fashion. When the best bid for an individual security moves above the upper LRP limit, or when the best offer moves below the lower LRP limit, fully automated executions on that side of the book are suspended, and quotes on that side are marked as slow under Rule 611 of Regulation NMS. During an LRP, NICE continues to accept orders, and most LRPs are automatically resolved as additional buy or sell orders are received within the price bands. However, if an LRP does not self-resolve in a short period of time, it is converted to a floor auction, and the security can be repriced outside of the band. When an LRP is in effect at NICE, other exchanges are allowed to trade through any quotes NICE marks as slow, though NICE cannot trade through the protected quotes at other exchanges. Also noted was that trading participants may cancel resting orders at any time during the LRP and reroute without any manual intervention. The presentation by NICE closed with a variety of statistics related to LRPs throughout the last year. In our September report, we will be providing more details on LRPs in the context of liquidity and market participant behavior related to the events of May 6th. We then concluded the July 29th subcommittee meeting with a presentation by our Division of Trading and Markets on what is known as the self-help exception to Rule 611 of Regulation NMS, something also discussed by the panelists. This rule generally requires trading centers to implement reasonable policies and procedures to prevent trade-throughs of protected quotations at other markets. Self-help permits a trading center to bypass the protected quotations of another market that is experiencing system problems. It was noted that the declarations of self-help by one market center against another are not uncommon as system issues arise from time to time. As with LRPs, our September report will provide more details on self-help in the context of liquidity and market participant behavior related to the events of May 6th. Thank you.
Thank you, Craig. Questions? Jack?
Just I don't want to ask you to play psychologist, but what was it that the market makers told you that prompted them to fear broken trades as much as the clearly erroneous trade rule? Why on May 6th? And there's lots of times where the market's volatile, and you could have that same sense. Was there some confluence of events that caused it? Because we hear it a lot in various aspects of this investigation.
Sure. Well, there's not necessarily a rule, but a bit of an unwritten convention regarding rapid price moves of more than 10%. And the exchanges can declare trades that fall within over 10% very quickly as erroneous. So when you have, this was not a matter of uncertainty in whether the trades were going to be declared erroneous. Even if there was complete certainty and the market makers knew ahead of time what would be declared erroneous, as soon as you get into an area where something can be declared erroneous, a market maker does not want to be caught with half a buck. So they will choose to not participate in the market at all than risk having one side of the trade be broken.
Yeah. Can you explain a little bit, if at the end of the day a market were still closed, or maybe this hasn't happened, if it were closed, how do the ETFs get priced? Is there a clear rule about okay, but
I think I understand the question. During the day, ETFs are priced like any stock. It's technical. It depends on the buy and sell pressure of that stock and of the ETF and the negotiated prices. There is a separate mechanism by which creation and redemptions occur, And that's where an ETF looks more like a mutual fund, where that is tied to the NAV of underlying securities. What happens is at the beginning of each day, I believe, a basket of securities is identified as the one that as what will be tradable for creation units, or would be redeemable if you're going to redeem some shares. Again, individual investors don't do this. This is only authorized participants in very large blocks. So even if the markets are closed, the securities can still be exchanged and redeemed. There are circumstances where you have ETFs on international markets where the end of the days don't coincide, and in that case, I believe that there are lags between the time that the actual settlement happens and then the transfer occurs.
Joe, did that answer your question?
Yeah, I was going to say, I believe, I don't know how you would take the closing price of an individual stock that was closed, but I assume it's still going to be a last trade. And I would think with the ETF, you would also record the end of the day price as being the last trade. I'm not sure whether there's any provision that would be different from that if there was you're talking about if there's a circuit breaker at the end of the day.
I mean, that was the question, but I mean, it's not like delivering wheat where you actually deliver the wheat. I mean, I assume that there is a cash settlement of some kind. Maybe John
I don't think there's any special end-of-day role that the ETF price plays, unlike a mutual fund.
Sure. Well, you actually can deliver the securities. So the securities go back and forth. This would only affect the case where, in lieu of transferring securities, you wanted to transfer the cash equivalent of those securities, in which case you would need to have accurate pricing for the underlying securities.
That was really the question. I guess maybe the question is, when you actually do the settlement, do they actually?
It's one of the things that keeps them close. It eliminates the discount on a traditional closed-end fund, right? So you can deliver, you can settle in cash or you can settle in securities. The preference is not to do securities because there's transaction costs, but
so when
you can do it.
Something's missing from it. What do you do? You actually do cash that off. I mean,
we will cash out. I don't know what happens if there's I'm not sure we've been through a period with the market closed
at the end.
But I'm sure it happened with the Spider on October 27th, 97, but I'm not sure how many other days the stock market's been closed at the end of the day. If there are others.
Jack, isn't it correct? I mean, like the wheat market, I mean, we're going through a lot of wheat convergence issues right now in Kansas City, and we had them in Chicago. But exchange-traded funds, you can literally deliver the securities, like you could deliver the wheat, at least in theory, in Kansas City, but and in practice, hopefully. But you have to be one of these authorized participants, and it only be done by large blocks. Is that because you ran a complex?
No, that's right. That's right.
So they don't have they hopefully don't have what we have, this convergence issue. But I guess they could deliver a stock even if it's not trading. Yeah. Is that right, Greg?
I believe so. The question about, well, what happens if you want to deliver a cash equivalent and the stock was closed is more general. I mean, how do you come up with what the end price for a stock is? So there are lots of ramifications that there's margin on the stock. So the exchanges would need to come up with an official closing price, and I assume that whatever closing price was picked would be the one that would be relevant to the transfer of ETFs.
Rick, did you have a question?
Yeah, just to follow up on the data integrity parts of your report of the minutes, which again was echoed this morning. Do you have a better feel with respect to exactly what those conclusions of data integrity were based on? Was it that they were seeing trades out of line with quotes, trades that would other have been trade-throughs, or were they trying to execute trades against quotes that they were continually unsuccessful for? What were they telling you, and do you conclude that there really was significant data integrity issues across the board, or whether they were spotty or what?
Most of the market participants explain that they put automatic triggers into their system to look for anything that has the potential to be erroneous data. And the first thing that they put in is any rapid price move. So while there were true data integrity issues that we are focusing on in various different platforms. And there were also internal system issues at some of the participants. It was accurate changes in prices that I believe triggered the most of these alarms. So as soon as you have a rapid change in price, even if that's real, someone has to look and see maybe that's not correct. And that then causes this huge cascade. When lots of securities have rapid changes in prices at the same time, then folks can't necessarily respond very quickly because each one of those securities need to be looked at individually to make sure that the prices are right. And if you are collectively looking at a whole bunch of securities and finding dislocations, your assumptions are either there's something greatly wrong with the feeds themselves, because we're seeing this everywhere, which would cause you to pause, or the feeds are completely correct and there's something fundamental going on, in which case that would cause you to pause. So regardless of whether or not the prices themselves are correct, any perception of that is going to trigger these types of pauses. And we think that was the majority of the issues.
Yeah, but I just want to follow up on that. I understand why people would not want to trade with, a market of volatility, but they were using the vocabulary of erroneous data. And you would have thought that there would be some mechanism to separating out these two kinds of problems. So far, what you've described is that they don't really separate the two. And one of the concerns is in breaking the trades, again, in terms of the erroneous data, erroneous trades, it's understandable why you would want to break erroneous trades. But it seems as if there's another principle that was here, which is trades that were not erroneous, but at prices that were larger deviations from what people had thought. And again, it seems to me that those are two concepts that are, really quite different concepts that are being mixed together. And one would have thought that there are ways of distinguishing between these two.
Yes, I think the clearly erroneous trades and erroneous data, you're exactly right. Those are completely separate concepts. The clearly erroneous trades and the cancellation of trades was one process that the exchanges got together, and we fully described in the preliminary report how that process worked, and we heard lots of feedback from the panelists on how they perceived that process. Completely separate from that is trading on erroneous data, erroneous market data, or trading when you think you're placing an order and you don't necessarily get the confirm back immediately, so there might be systems issues. That's a completely separate path. Sometimes I can imagine a situation where a trade is erroneously placed because of erroneous data, and one might want to claim that therefore that trade was clearly erroneous. I don't think that's really what played into the afternoon of May 6th. Those are two separate processes.
David.
Could you describe the process for choosing the 60% figure for declaring those trades, which ones should be broken or not? First of all, was it across all of the trading centers? And secondly, why 60%? Why not 55? Why not 65? Why not 35? What was the thought process?
So three questions. The process, was it across all markets? And then the thought that went to the number. But the first thing I see, Rick is shaking his head. But Greg?
Sure. I think I might defer to Rick on this particular question.
I'm glad you're answering it, Greg.
So the exchanges did get together after, and I know that they agreed on that. I don't know if I can comment on the details of the why.
You say the exchanges. What about the other markets?
I believe that clearly erroneous trades are within the domain of the exchanges. I don't know, Rick, if you have.
I can try to help, but trying to explain the process is maybe beyond me. Each of the registered exchanges trading in a security or who had trades in a security, plus FINRA, which through the TRF or whatever it stands for, facility, which represents essentially the internalized trades of the firms and some of the dark trade volume, work together to have a single decision with respect to erroneous trades. Erroneous trades are relatively predictable from the standpoint of how those decisions work, and they're set out, and the SEC worked with the exchanges for some time for that when it involves a single erroneous trade or a machine gun-like number of errors going in the same security. There is much more flexibility and difficulty in working it when instead it stems from a market reaction that then flows like a waterfall from that in large numbers of securities. And in that situation, there's much less guidance. There were some similar situations in September and October during the credit crisis, but not quite like this. So in those circumstances, the exchanges had more flexibility and, on the other hand, less guidance of how to work in a situation where, in simplest terms, there was no clarity that there were any error trades. In fact, there weren't. What there was a massive market panic reaction that, from a market structure standpoint, resulted in trades that simply couldn't be justifiable. And in that situation, that obviously the last one was an opinion, not otherwise. In that situation, the exchanges were chary about only breaking, and exchanges with FINRA, about only breaking the most extreme trades because, as been mentioned several times here, these positions don't stand alone. They are traded out of. They are part of hedge positions, part of a variety of combination positions. So the breaking of trades, particularly when it's not terribly predictable, always has consequences. So I think it's fair to say there's nothing specifically justifiable about 60% as a number rather than 50 or 70. It was an effort, given the unique nature of this and the absence of any evidence of a particular area or trade, to only knock out trades that would appear to be, by at least some standard, undoubtedly, for persons involved with it, not normal and not real. And for better or worse, that was the point that the exchanges landed on, was at 60%.
What did you do, put a bunch of pieces of paper in a hat and pick out one?
I wasn't there, so I won't testify how it happened.
Do you have any information about who the market participants were whose trades were broken?
We're still working on the exact details of that, and in our final report, upcoming report in September, I think we'll go into more detail. But our initial inclination was to follow the retail path, and we believe that quite a number of those trades were actually retail trades. Most of the professionals got out of the market as soon as the decline started happening. So certainly the market makers began to pull out. Your institutional asset managers would have pulled out. So many of those trades, we believe, were originally retail trades.
So, Greg, you think, I mean, it's a question probably more on the SEC, FINRA, but that the September information will show, or I know the May 18th said how many trades, but you're asking who was behind them. You think that they will be able to summarize that for the public?
Yes.
Great.
Just to follow up from your comments, that seems to say that the last part of the declines down to the stub quotes was almost all due to retail trades, and it was the retail traders that were really causing this dramatic decline.
Well,
let me see. Causing or getting at least the question is who is getting stuck with the bad side of that trade, and that could be because of the way they structure their offers.
Well, I take it that a group of stop-loss orders from the retail traders or market orders from retail traders, since you say that all the professionals are out of the market. So now we have the last part of the flash crash determined by retail trades rather than professionals.
I don't want to get too ahead of the final results in September, but what we are seeing is that most of the professionals had exited the market, but many of the retail investor, some of them were stop-loss orders, so they were triggered automatically. Others were market orders that folks put in right there and then as they saw the decline going down. Though it was less around they got stuck with the bad trades, they were the only ones trading at that particular time. So you went to stub quotes, and again, those trades were then later canceled for those obvious reasons.
Well, then to go one more step with it, at what point from 60% up towards 40 and 30 where the professionals out and the retailers still in. You know that?
I don't think we have details at that level. What I can tell you is that there were about 20,000 broken trades, and if you plot the numbers of securities and the trades and what the lowest point was, you will find that it's a barbell. Quite a number of the trades fell 10, 11, 12%, and then a huge number fell 90% or more. The area between 20% and 90% is very, very sparsely populated. Either you went all the way down or you stayed at the 10%, 12% level. So the difference between 50%, 60%, 55%, we're literally talking handfuls of trades in those regions. So we didn't see too many stocks fall 48.3%. Either you went all the way down to a stub quote or close to it, or you went down a nominal amount and then came back.
Were they mostly low volume? I mean, small lot sizes too?
Well, that's something that I think we'll have some cross-sectional analysis on that in the final report. But I think the answer is yes, but that's not necessarily saying anything about the broken trades. Most trades are small lot sizes today.
Spread
Susan?
across the whole market?
Susan, could you repeat that?
Were the broken trades spread across all markets?
They were, and I believe in the preliminary report we have a table that illustrates for the 20,000 or so broken trades. Different markets had different percentages, obviously. The New York Stock Exchange did not have any broken trades because of their LRPs. Others had less broken trades because they have collars on their orders, so they do not accept market orders. When they accept a market order, they'll actually turn that into a limit order, and others execute the market orders directly. One thing that I'd like to note is market orders are often converted to limit orders before they get to the exchanges themselves. So there's a limit to what the exchanges can do in terms of treating a market order. If they receive a limit order for 1 penny, then it's a limit order for 1 penny. So the situation is actually a little more complicated than just sending the retail orders straight to the market centers themselves.
Earlier we were talking about a large fraction of the broken trades being ETFs. And I guess can you answer some of these same questions about the ETFs? I mean, were they a lot of retail trade in the ETF that were broken?
Yeah. So my comments were really for all broken trades, and the majority of the 60 some odd %, et cetera, or more of the broken trades were ETFs. So yes, everything applies to the ETFs themselves.
Susan, and it was my fault that I didn't recognize you earlier, did you have either questions for this or even if you just wanted to share, because there were 5 or 6 really important topics about market orders and limits versus, all the 6 or 7 topics we talked about earlier that you wanted to share with the other members of the committee?
No, I guess I was I remembered that it was ETFs that were predominantly the broken trades, but I also then I didn't remember about whether or not the futures markets had many broken trades.
Jim can answer that.
It did not have any broken trades.
Thank you.
Any other questions here? I think we're going to stay in our seats, but I think doesn't Greg and Steve Sherrod from our side are you going to do anything or no? No? All right. So that even makes it easier for me because then maybe it's already been done. So you can stay, but I wanted to thank Greg Berman and Jim with regard to what they've done. As we said, again, early September, the staff will deliver a follow-up report. So we'll have the May 18th, and then we'll have this follow-up report. to the Joint Advisory Committee based on the research they've conducted these last 3 months. And then once the committee has received the report, this committee received the report, the next step would be to link the staff report back to the broader mandate of this Joint Advisory Committee. And to that end, we would subsequently ask this committee to prepare a document. Maybe it's a shorter document than the staff's done. Well, it could be as long as you want it to be. But we're not saying it has to be, but be delivered to the two commissions, ideally, by early October. We know that you're all busy and everything, but, we're trying to move this along. That would address the following points. Basically, any specific recommendations that you may have regarding cross-market policies directed and related to the issues on May 6th. When cross-market issues are all of the 6, 7, 8 items earlier, and Chair Shapiro had to leave, but she particularly said some of those items earlier that were identified around collared market orders and so forth. But the pilot program, all of the things that we talked about earlier, the pauses and the limits and so forth, those topics. But certainly included in that is the cross-market policy, circuit breakers across the markets. And then secondly, just general areas of further consideration for the CFTC and SEC policy based on any broader cross-market themes. And some of those cross-market themes, again, were talked about earlier today. I mean, cross-market themes about the fragmentation in the markets and so forth, which were debated this morning. And there was obviously a lot of things that were raised by some members here, priority rules and things like whatever the committee wants to advise us on, But the two main areas are the cross-market issues related to May 6th and then just broader, advice that you have. This committee doesn't go away with that report, by the way. It goes further, so you're not off the hooks yet. So that's to aid you in the process. We're happy to have staff members of the SEC and CFTC work with the Joint Advisory Committee, collect your individual thoughts on each of the points, aggregate, synthesize the information, help organize the final document. Greg Berman and Robert Cook is here from the SEC, who runs the Division of Market Oversight. Do I have the right title? Trading and Markets. We have different names over here. Maybe we need to harmonize that too. Jim Moser and Andre Karolinko, who you've met, who are from our chief economist side, but Steve Sherrod, Rick Schiltz, and others from our Division of Market Oversight are all available to help out as well. I want to turn to my fellow commissioners because they also, Mike Dunn and Jill Summers and Bart Chilton, I think each have some thoughts too.
Well, thank you very much, Mr. Chairman. And first and foremost, I really like to build upon what you were just saying and recognize the importance of this advisory committee to us to ensure that we have an orderly working marketplace. A lot falls on your shoulder, and I appreciate, Mr. Chairman, you and Chairman Shapiro getting such a distinguished panel here. I've just finished reading Joe Sticklett's book, Free Fall, and I'd highly recommend it for everybody. Since we're not paying them, we can plug them. I'll plug the Stern School of Business in Northwestern as well. It has great institutions. But one thing really struck me today, and that was hearing from the panel members that we had, not the advisory committee, but the panel members, that what happened on May 6th can happen again. In fact, they expect it to happen again. And, Mr. Chairman, you made an analogy of a terrible auto accident that I was involved in, which happened in a very quick time, and what happened to stock and Accentua. But there was a big difference. In my case, somebody broke a rule. Somebody went through a stop sign. We don't have a rule here that was broken that caused this. And that is what we're looking at this advisory committee is to provide us with the rules of the road to ensure that these accidents don't happen in the future and certainly don't happen to the magnitude that they happen. I want to build on something that Chairman did when he started, and that was talking about the Frank Dodd bill. And it has mandated that we work more closely with the CFTC and the SEC working together. And the two chairs have been working. I mean, they've already started these meetings that have been mandated. Staffs are going through those. And I hope, Mr. Chairman, that we would follow up in a similar format that we have here, where we have an open public meeting where everyone is privy to the types of recommendations and things that we were mandated to take a look at and what our staffs are going to be recommending to us. And to that extent, there are other regulatory bodies that I still feel we ought to be working with as well to ensure that we get that out there. And I'd really like to thank the staff of both the CFTC and the SEC for the work they've done for us as the Commission, but also for this advisory committee, because since we're not paying you, we don't expect you to shoulder all the burden of that. And as we stay in the agriculture area, work them like a rented mule. Just get as much out of them as you can.
Wow, I don't know what to do with that last statement. But on the one thing I want to say, Commissioner Dunn is absolutely right. The SEC and CFTC are working tirelessly together, and we are on the Dodd-Frank bill going to have a number of the staff roundtables. I can't remember exactly how these are called, but some of them may even start later this month. And between the SEC and CFTC, I think they've identified 4 or 5 topics. They'll be open to the public. I don't think we'll have as many cameras here, but they'll go through a number of topics related to data, related, I think, to governance, related possibly to these new swap execution facilities and so forth, and jointly hear from the public on very critical issues. And the SEC commissioners and the CFTC commissioners will be allowed to go, but it's staff's going to run them, which saves Mary and me from running these things too, probably. Commissioner Summers.
Thank you, Mr. Chairman. I think just following up on all of that, and want to say how much I appreciate the panelists being here today and all of the committee members. It's extremely important for us to look at this coordination across markets, the equity markets, the security options, and the futures, and how to appropriately impose the tools that we have on all of those markets, like circuit breakers. I think that as the markets have evolved and products like ETFs and equity index futures have increased, the interconnectedness of our markets and the markets that we each regulate have also increased, yet we have completely different market structures and completely different rules on either side. So, some of the issues that we talked about today, high-frequency trading, co-location, and just general market structure issues are before both of our agencies. So I think I can't really stress enough how forums like this to increase the dialogue and cooperation between the two agencies is extremely helpful to me, but I think to us all as regulators. So thank you all for being here.
Commissioner Chilton, we're bound to get a soundbite here, I know.
Thanks, Mr. Chairman, and thanks everybody's staff in particular. I know you've already been working like rented mules, and thanks to the advisory committee. People are going to say, is it going to happen again, like Commissioner Dunn said, and the answer is it could. I think it's less likely that it would today with some of the changes that are being incorporated, and as we move further down the road, it'll be even less likely. But, you can't give certitudes. But as we're talking about all these issues, and it was fascinating, all of the suggestions that the panel had, but people come up with these sort of phrases about what happened on May 6th. They say, well, it's a perfect storm, or it was a collection of culprits. And I think sometimes it's too easy for us to rely on that when we don't know what specifically it was. Well, it was a bunch of things. I'm not saying that it wasn't a bunch of things, but by the same token, I think that the panel and the staff should be still looking for a smoking gun. And one of the areas, and I'm not saying that this is a smoking gun, but one of the areas that was not discussed a whole lot today is this gap between the consolidated tape and the premium tape on the New York Stock Exchange. And at times there was more than a 20-second delay. And so, what I think we need to do is make sure that there wasn't any price trading, these algorithmic trades that could have gone in and simultaneously bought on the real-time feed from the New York Stock Exchange, and then sold on the delayed feed, the consolidated feed, boom, boom, right away, hundreds of times, and taken just a minute advantage individually, but collectively it could have been a larger amount. Now, when I started thinking about this, we have a technology advisory committee that Chairman O'Malley convened a couple of weeks ago, and I asked these sorts of questions then to make sure that I wasn't sort of a conspiratorial person thinking this is crazy. And 4 of the folks that are on this panel, eminent experts, said they thought I was crazy to ask. Of course that could be going on. And so I don't feel as nutty about asking the question, and maybe there's nothing to this, Greg or Jim, but that gap, 20 seconds, might not be a lot in our lifetimes, might not be a lot for a lot of folks. Basketball game could be something. In these markets, it could be huge. And so I hope we make sure that these algorithmic price pirates aren't seeking false profits, that they aren't trying to go after something they shouldn't have gone after. So thank you again for everything.
Thank you. Rick, do you have any? Greg, do you have any? All right. So, it's something that, Joe?
I just, 2 questions. One is, we've been talking about the U.S. market. I gather there have been similar spikes in a couple of other markets. Has your staff looked at any other markets where anomalies of this kind have occurred? And because we've been talking about different rules and the impact, it might be of some interest to see whether they've gone through a similar kind of exercise.
We're aware of the different structures that exist in different international jurisdictions and other types of markets. There is something that's very unique around the U.S. equity market in that it is fragmented. There are different market centers. There are at least 9 to 12, depending on how you count, the ones that are visible. And as we've heard from a number of panelists, people like to use the number 40 as the total number of venues that are actually out there. 40 times 40 is 1,600 different combinations. So while there are certainly things that we can learn from observing these types of patterns in other markets, a lot of this is within the U.S. that we'll have to study.
Yeah, I guess a particular question I was concerned with is if there are these kinds of spikes occurring even without this complexity, ours may be more prone because of the complexity, but it would remind us that even without that, we have something to worry about.
Agree.
And we're also looking at, as I mentioned, the order book activity on other days. 2 of the days, as I recall, were in the third quarter of 2008, where there were sharp breaks as well. So what we want to do is analyze and see, in what ways was May 6th different than those sharp breaks, and how did the order book evolve on those days?
Let me just mention, I think Australia had a big spike. It was an upper one. And in their case, it was a wrong order. Somebody pushed the wrong button. But the reason I mention that is it shows the fragility of the system to a mistake. So that's at least one thing that one wants to worry about. And if that's the case, then obviously in a world with all the kinds of fragmentation that we have, the problems could be much worse.
We have some outstanding research from other error trades done in the United States. There aren't too many to actually analyze, but what we found is that in general, the market does come back very quickly, recognizing that it is an error, and it just bypasses it. I'd be glad to send the advisory group that paper if you like.
There's one more question I wanted to ask.
Four more.
And that has to do with what you mentioned, the Dodd-Frank bill. Are there particular regulatory issues that they raise that you think interact with what we should be doing?
Well, I can't speak for the SEC, and as you know, the CFTC largely swims in the lane of derivatives, foreign exchange derivatives, which we call futures now, but then these newly regulated over-the-counter derivatives. I do think market structure issues here are going to play a tremendous role because, as you know, Congress enacted a bill that says all standardized derivatives, that which can be cleared on a clearing platform, has to come to a clearinghouse. And there's various estimates, but it seems that would be a majority of the over-the-counter derivatives marketplace by far. And that those have to then be exposed to transparent trading venues. And these transparent trading venues can be swap execution facilities. And so from the world of the futures market, which has been, as people have pointed out, has been sort of less fragmented than the securities market, this over-the-counter derivatives marketplace may well have multiple trading platforms. In fact, there could be dozens. There be, the bill actually fosters competition amongst these trading platforms. So I think it will be helpful as you're thinking about fragmentation and market structure issues. I mean, Congress has dealt with the broad policy. There will be swap execution facilities. They're supposed to be open to multiple participants, making bids and offers to multiple participants, so it's what people call many-to-many. There is pre-trade transparency, but how they all sort of work and in combination to enhance market liquidity, enhance transparency, enhance efficiency of markets, which is what part of the goal of the statute. I think that will be helpful to get your advice. Not that you might not have advice on clearinghouses and other things, but I think that it's probably more around the trading venues that it's very similar types of issues might arise.
One in particular was raised this morning that which is the bill encourages trading on exchanges and clearinghouses, but also allows for over-the-counter. And some of the issues we've been talking about, dark pools versus transparency, want to raise the concern that how you organize the transparent part can affect the magnitude of the trading that goes in the dark pools. So it seems to me that that's one of the things that...
Absolutely. I think Congress addressed part of that in that they said even on the bilateral transactions, those that are not on the trading, have to be reported in a real-time basis as well. So there's post-trade transparency. We have to sort through the SEC, and we have to sort through how to do that. But in terms of what's on the swap execution facilities, Congress also addressed it by saying it's multi-party to multi-party. Some of the dark pools currently in the equity markets, the darkest of them are sort of proprietary platforms, if I understand. And it appears, at least to this reader, I can't speak for my fellow commissioners, but that Congress sort of addressed that and said, no, it has to be multi-party to multi-party. It might be addressed right there in the statute in a sense, but those will be subject to interpretation, obviously.
I guess I'm wondering what we could do that would be useful, and perhaps maybe the question is what's actually feasible in terms of the various incentives for public liquidity display that were talked about today. Things like, treating cancellations differently from just having them freely available, changing priorities, changing access fees or rebate structures and so forth, which are to some extent under regulatory supervision and to some extent our exchange set. What's the scope that we can think about here?
Well, I would hope that you would help the two commissions on things that are, within our authority and jurisdiction. So, though you could take up, I think it was one of the earlier panelists' thoughts to, they had a recommendation about the tax situation. The SEC and the CFTC don't have those authorities. So I think what would be best is if you recommended things that are either within our authority, or if you think there needs to be a change in law, that it would a change in law related to our specific authorities. Obviously,
when I used the word tax, I guess I meant charge for cancellations.
Well,
Good exchange charge for cancellations.
I think the wonderful thing about advisory committees, and this one's got an esteemed group, but is that we're not looking to limit you. I mean, if you have a good recommendation and there's a consensus, we want to hear that. And so. But the immediate thing is the events of May 6th and the cross-market issues there, and then obviously some general market structure issues. And since the panel doesn't go away, I mean, we're hoping that there'll be lots of other advice along the way too. But we'd like to. So what's feasible is also what is doable in a timely way. As the first report from the advisors, the 8 of you. Susan, any?
I guess I was wondering, after this September report, and if there are recommendations that come out of that, relating to circuit breakers, or different types of orders, some of the market rules of trading kind of stuff. What other kinds of issues are the two commissions interested in having the committee look at?
If I could ask that, because you're really saying what might be the agenda for this advisory committee beyond this, and that's an excellent question. But why don't you allow Chairman Shapiro and myself, working with our fellow commissioners, to kind of come back to you as we sort through this first. I think if I understood your question, but maybe I didn't. I don't know, Commissioner Dunn.
Well, it would be good to hear from the advisory group of what type of things they think they ought to look at. That would be very helpful.
So, I mean, this group was set up immediately with the May 6th event, but Chair Shapiro and I have been talking about it since the presidential transition. Then acting Chairman Dunn had sort of suggested we have this too, and we worked with Congress to actually get this authorized. Believe it or not, we had to have this committee authorized because we couldn't spend money on behalf of the SEC, and they couldn't spend money on behalf of us. You had to change an appropriations law to do a joint advisory committee. It's a great country. And so we did that with the support of many members of Congress. And so we really do look this to be a committee that goes on to talk about emerging risks. That one of the things that came out of the crisis of 2008 is really to have an outside group of experts advising these two market regulators. It brings some harmony amongst them, but beyond the harmony is to really say, well, what are the emerging issues? What are the things that is the next thing that's on the horizon? So you got sort of commissioned into service with a specific task of May 6th, but it's much broader than that. It's what do you see on the horizon, and what are the things that you think the nation's two market regulators should be, thinking about? But that's past October.
Yeah. Can I just make a comment related to the discussion we had earlier this morning, which it's very clear that there's been very big changes in the structure and the performance of these markets in very recent years, which affect both the liquidity of the markets and incentives for various market participants to gather information. One of the other previous one you talked about the incentives of those who are doing fundamental research to their ability to extract returns for those investments. So in some ways, it seems to me that one of the questions is not only a question of stability, but also even the efficiency of these markets with respect to the issues with which the fundamental roles these markets play in making the real economy work better. And I think that should be an important focus.
Maureen?
Well, I was just going to say to some extent, the SEC's concept release also is all about that. And so I think, to some extent, we want to make sure that we're not duplicating what they're doing, but actually moving beyond that as well. And so certainly those issues are there. And the SEC has got that out, and that's been out now for, 3 months, 4 months, something like that. So hopefully we'll be able to add to that as well.
Just could I make a comment about staffing? We don't have an identifiable staff that reports to us. I presume that the SEC staff and the CFTC staff are available to us. I would hope that we would receive from the joint staffs a kind of summary of the various suggestions that have been made, so that we wouldn't be starting from scratch in September when we receive a document from you.
I think, David, that's an excellent suggestion. I think that technically speaking now I turn to, you don't need to speak, but Jim and Tim, right, because you're from aren't you officially the committee staffs? Yeah. So Jim Burns and Tim Karpoff just got outed. But can you follow up, because I think it's excellent. So just what are the things that outside market experts or the panelists have suggested, and what's the sort of things? That's what you're really saying.
Yes, and so that we can consider those in the time frame between now and the time that we receive the report, so that the report then has some relevance for us in terms of the kinds of suggestions we might make. And that would give us also an opportunity collectively to make other suggestions that any of us might have. And I would hope that we could have some procedure for circulating papers without having a public meeting about what we may think.
All in compliance with the Federal Advisory Committee Act.
I understand that. Right. And you've given us over the past some documents that have been helpful, some sets of testimonies, but I would also urge the staff to give to us, if it's available to them, any written papers and documents that may be helpful to us in making decisions and evaluating suggestions. This is, as you know, an extremely difficult subject matter and very technical, and we need all the help we can get.
Both excellent suggestions. I think with that, I'm supposed to turn to just to make sure this is the administrative side, but we need to discuss and approve the minutes of June 22nd meeting of the committee. So I'm ask whether there's any discussion of the minutes. They're in your binder. Do I hear a motion to? Moved. Do I hear a second? All in favor?
Aye.
Aye. Susan? Any opposed? Looks like the ayes have it. And then I guess, what do I do next? Hopefully I can adjourn. And then I just want to really thank everybody. I want to thank my fellow commissioners, all the panelists, and the committee members. I think this has been a terrific dialogue today. And so I would ask for, if there is there any other committee business? And so I would guess, not hearing any other committee business, I can declare this meeting adjourned. I might have to entertain a motion. It's a FACA committee, right? I have to entertain a motion.
So moved.
Any second? All in favor?
Aye.
Aye. All right. The committee's adjourned.